Alrighty. Let's see, everything's up and running. Alrighty. I'm going to be using this channel here on Discord as a place where if anybody wants to talk, they can. Here we go. That's done. Okay. All right, we'll wait a couple more minutes, let everyone join. I'm going to be using this channel here on Discord.
Morning, bro. Morning.
Good morning, brother. How you doing?
Good.
Good. Nice to see you, man.
You as well.
Wait a couple more minutes here. Let some more people join. I'm gonna stream this on YouTube just to record the session as well, and I'll have this Discord channel open as well, and I'll just kind of go through the questions and we'll take it from there.
Nice. So
Yeah.
we'll be able to just go on YouTube and rewatch it.
Yeah, exactly. Yeah, it's just gonna be easier that way. Yeah. Okay. So you guys added a couple more questions yesterday. I have to add these in here before we start, and then we'll be good to go. 7, 8, 9. 10, 11. Plus 11. Okay. Okay. All right. So on this, can you guys see my screen? On Discord, you probably can't. Let me share. Share your screen. Screen one. Go live. Okay. So you guys should be able to see my screen now. I'm going to have one note up here. Let me just post these questions in. 7, 8. Okay. Good morning. I see a couple more people joined here. I'm just getting everything a little set up and see that we got a couple more questions here, and then we will hit the ground running here. Okay. Alrighty, so let's get this started. Firstly, I'm just gonna go through this list of questions one by one from top to bottom, and I'm gonna be doing a lot of talking. If you guys have any questions, please feel free to stop me and ask. I've gone through most of these questions already on my own time and just kind of started the response in which I wanted to respond in. These last couple that I got right now, this is going to be straight off the dome because I haven't seen them before. And I read them briefly yesterday, so I know that they were there, but I didn't add them and actually go through them yet. So we'll just go through those as well. Grab your coffees, grab your tea. and let's get the show on the road. So, okay. The first question by Mr. Banks. This question, and I hope everything's going to be working now. Let me just double check. We have. So we'll just go through those. Okay, YouTube is working. Cool. Discord. Everybody seems to be in here. I hope you guys can hear me fine and see my screen fine. If you can't, please let me know. Also, I'll have. Hi, everybody. Tian. Okay, great. Cool. Okay. And I don't know what the best way for me to answer your guys' questions would be. You might be able to. Is there even a comment section on this live? There isn't. Chat is disabled for this live stream. Okay, yeah, you could leave it in the Discord chat. So I'll check this briefly every now and then, or just use your voice. Okay, so let's get this started. Not that. This. Cool. Okay. So firstly, we have Mr. Banks. Mr. Banks is asking how to find A+ setups, when to go break even. And I think that both of these kind of go hand in hand. And so, what is an A+ setup, right? The criteria that I had for A+ setups when I first started this was that number one, I need to have range. Range in the form of either you are in an uptrend, you have a pullback, and the first candle closes bullish. Now you have this range to capture back to the upside, and this is a clear high. Same if we're coming off of this top key level, and we're starting to go down, we have a bearish candle close, we have clear range back to the downside. And so number one criteria for any A+ setup, any good setup, is having clear range back to the upside. You need to have a confidence that the price is going to continue back to that key level, or back to that, or fill that range, or go back to a previous level that it was at, right? Because we see price repeat itself over and over again, but if price just leaves and there's no levels, there's no nothing, it's making all-time highs, you don't have any sense of direction. You don't have any sense of how far is price going to go. When you have range, that gives you clear direction, clear expectancy to take the trade. And so you need range. Range is number one. Number two is you need rejections. Now, not all the time will you get rejections. Rejections can come in the form of a bearish candle into a bullish candle. Sometimes you'll have bigger wicks, right? Sometimes you'll have no wicks. But to me, in both scenarios, this is a rejection, right? This is a rejection. This is price trying to go down, failing, and then now starting to go back up again. So in whatever form you want to say this in, this is where your A+ setups occur, is when the first candle is red and the second candle is green. When the first candle is green, the second candle is red. That's something I've noticed recently with my A+ setups, is that like all my best trades are directly after, if I'm taking buys, it's directly after a bearish candle. Or sorry, not directly. Let's say I'm taking buys, so it's a bearish candle, then bullish candle, and I'm in the next bullish candle. I'm jumping into the trade as soon as I possibly can to start following the trend going back to the upside, right? This is our exhaustion with this bearish candle, and this is our continuation with the bullish candle. And so I'm in the very next bullish candle. And so you need rejections. You need price to have good range. And thirdly, simple price action, right? I always talk about this, and this is something that I'll use all the time. We have a few setups within this whole sequence right here, right? And so if I was to go onto the charts, which I didn't necessarily really want to do today, but I think this will drive this point home a little better. I have to sign in here. But essentially, let's just say, oh boy, why is it? Here we go. Essentially, what I'm trying to say is that there's a couple different setups that you can take, right? And so let's use this for example, right? This is a perfect example. The number one setup, right? If we were to just break this down in a very, very generalized way, right? We're looking at gold. We're looking on Thursday, August 8th. I'm going to review a bunch of trades with you guys later on too. But you basically have price, right? Price is creating highs, creating lows, creating highs, creating lows, creating highs, pulling back, or this wasn't a high, whatever. Now it's creating highs. Okay, whatever. Point proven. And so what I want to identify in this, going back to this simple structure right here that you guys see, if you look at this simple structure, you basically, what you can say to yourself is, one of the trades that you can take is you could take any of these bullish candles on the way up, right? If we're in a push phase and you think that it's a push phase, you can theoretically take any single one of these candles on the way up. As soon as you get that first, right, this is what I was just talking about. You have a bullish candle and then you have a bearish candle. That bearish candle, and then you have some kind of rejection. That bearish candle now provides an opportunity, and you could take the next bearish candle for sells. Now, do I think this is the best opportunity? Probably not, but it's definitely an opportunity you could take. Now, going towards the question of A+ setups, right? This is where you have to exhibit a little bit of patience, right? You have this strong push phase, so you wake up at 7 a.m. here. You don't get a trade, you don't get a trade, you don't get a trade, you don't get a trade all the way. It starts coming down, you still don't get a trade, you still don't get a trade. Now it's 9:15. 9:15, you get a nice strong bullish close. You have clear range, right? What I'm talking about, range. I'll always say that. Clear range back to the upside. And a nice bearish bullish candle with rejections, showcasing that this is the part that we want to be looking for, is this turnaround point, right? This turnaround point. We're looking for these turns in the price action of every single pair that we're trading. So we have this bottom turn here, right? It's going from exhausting the uptrend to now going back into its push phase, to now exhausting the uptrend, to now going back into its push phase. And, this is never going to play out. I mean, sometimes it does play out perfectly, so I can't say that. But 80, 70, 80, 90% of the time, it's not going to be very perfect. You're going to get, you're going to have very interesting things happen. It's like here, like, this candle broke, then you see this candle coming back down, and then this one breaking again. It might be a little confusing at the moment, and then after it happens, you're like, oh, this is where price forms support, and as price is coming down, you see this bearish candle, you see this bullish candle start forming, and now this becomes more clear to you. You're like, oh, this is kind of like a rejection area. This might be one of those turning points that we're talking about. And so you have to use a little bit of your intuition here and just your creativity when you're really plotting these levels and getting an understanding for them. It's like the longer you do it for, the more levels you plot, the more in tune you get with the markets, the better you will be at it long term. Certain things just make sense to me and don't make sense to me when I'm plotting levels. But the main thing that I look for is the low that creates the high. So those are our turning points. So this is the low, this is the high. This is the low that created the high. And yeah, you could argue that, no, well, Mike, there's a low right here. These wick rejections are showing me a low, and that's what made the high. Sure. And I'm not going to argue with you. I'm going to tell you you're right. Whatever. Doesn't matter, right? And you, in this case, you would have been like, oh, it rejected off of that and kept going. Perfect. Whatever. It doesn't matter. But the main point is to find these areas in the charts where price is turning, and try to get into that turn as soon as possible, right? Here, yeah, go ahead, man. I thought somebody had a question. I guess not. Okay. Let me check the chat here. Okay. So you want to be looking for these turning points. That's the most important part. And so that's number 3. That's point number 3 on how to find A+ setups. You need range. You need rejections. So you get in right at that turning point, right when it starts happening, right? And then number 3 is just simple price action. You want to be in the uptrend. So you want to be looking for the bullish candle buys in the uptrend. You want to be buying them as low as possible, because if you're believing that price is in an uptrend, if that's a belief that you have, then you could very easily say to yourself, okay, if I believe that this is true what I'm saying, then the lowest bullish candle that I get, meaning the furthest down on the charts, this is the furthest down at this moment in time that we're getting, is the best one to buy because we believe price is going to continue going up. And so in this case, if you bought, and hold, you could easily hold back up to the highs. And then if you want, because you're in an uptrend, you could easily keep holding up further. And now how far you hold or whatever, maybe you just wait for one bullish candle close above the level. That's where you close. Maybe you wanted to get 10 pips, so that's where you close. Maybe you waited for 2 candle closes, and that's where you close. This is all stuff that I can't teach. It's more intuition based and really just in the uptrend, you have candles that will close and it will continue going up. And so in this case, it went up, right? And this is the same for downtrends. This is the same for downtrends, same exact thought process, same exact everything. And everybody I feel like will have their own types of A+ setups. Some people might like, this is my favorite personally, is uptrend and this bullish candle close into this one. By far my favorite setup, right? This is one that I actually took on Thursday on gold. This is a beautiful setup. And you'll see it time and time again, another one. And I mean, this you could say in multiple ways, right? You could say that, okay, well, price had a low, broke the low, and then maybe broke back in. I don't know, whatever. It doesn't matter, but it made sense to me at the time. Clear range to the upside, bearish candle, bullish candle, rejection. Simple. And you'll see this pattern over and over again. Bearish candle, bullish candle, rejections, uptrend, bought the next candle. This was actually a loss or a break even or something, whatever. I could go through the charts and it over and over and over and over and over again. My gold chart isn't very sexy right now. Neither is my G1. Oh well. But yeah, so someone have a question here? Yet again, GU, same thing. You have a uptrend, a nice bearish candle, bullish candle, bought the next one. You'll see this over and over. Bearish candle, bullish candle, bought the next trade. This was counter trend. And so, when you're using this type of philosophy, when you're using this type of entry criteria, when you're waiting for those, I don't know what a good word to use for this is, but it's basically these inflection points, right? They're the changing points. It's like it happens here, and then it happens. Oh boy, it happens here, right? And then you start kind of looking at these a little differently. It happens here, and you can, when this is low volume, I'm not going to look at this area. Don't think I'm just skipping over it, but this is going to be a nice one to look at. So it happens here. It happens here. 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 And so you guys are getting the point. And so essentially what I'm trying to say here is that these are the points where price comes to and then starts turning. And then comes to and starts turning. And this is how the market works always. Always. And so like, regardless of, price action even, and saying, okay, uptrend, higher highs, higher lows, lower highs, lower lows. Yes, that is my bread and butter. That is my whole entire philosophy. But it's not the holy grail, because you still have to understand that price will just come to a point, wherever that point may be, and prices will be like, okay, well, I'm going to start rejecting this random area, and I'm going to start closing in the other direction. And so that's your first sign with this strategy, to say to yourself, okay, well, if you're going to start closing in the other direction, then I'm going to start taking you in the other direction and see where you take me to. And so here, it's like bearish candle, came back down. We have a low to support that evidence. We have a bullish candle to support this uptrend. And we say to ourselves, okay, we'll enter. And we enter the trade. And so all of these that I went through are A+ setups. And I wouldn't look for anything else if I was starting the strategy, or if I was using the strategy on a daily basis. I would only look for A+ setups. I would only look for the best candles. I would only look for these candles, because you will start seeing more opportunities as you practice the discipline and the patience to trade only the best candles. And that's why a lot of the times, like, I don't absolutely love sharing my trades in the Discord because some of them are very questionable, if you will. And it's just that I see this happening so many times over and over again that I'm like, I want to try this trade. I want to try. I want to put some risk into this trade because I've seen it happen before. And the same thing will happen for you. Is that you will start. It's like, I think this is a trade I took. Yeah, this is a trade I took right here. Actually, I remember this trade. So we have a bearish candle. The next one closed bullish, and I entered on the next bearish candle. Now you might say to yourself, well, Mike, isn't that like against your whole like strategy and everything? Well, 1 minute structure on here. While I was taking this trade, I didn't even notice that this candle closed bullish because I had my stops above this wick. And once price made this bullish wick, it never came back to break that wick. It just continued going down. And so on the 1 minute, I didn't even realize this candle closed bullish. It was 15 minutes, so it was quite a bit of price action that happened. But this candle opened, made a small little wick, and then started going down. And I was still very happy with entering this trade. And so I took it. And I ended up hitting TP. And it's like, this could be a reason that somebody else doesn't take the trade. But I've seen this kind of sequence happen before where, you have a bullish candle off of some kind of a high. You could say either this was your high or this created its own high. I don't give a shit. Whatever you guys want to say. It really doesn't matter. Then you have a bullish candle off of this high and then another bearish candle. And you could enter those, and those are fine. And so you'll start seeing more and more trades, but first I would focus on the best setups that you possibly can.
Hey Mike, I got a quick question so you don't leave on that.
Yes.
Right at that example, being that you showing us how to take A+ setups, and
Yes.
you can see that this market was in an uptrend, and then once it broke that support, I'm assuming once the bearish candle started going down and then started pushing up to then create that bearish candle, right?
So you're saying, okay, so you're saying that we're basically assuming that this market structure is in an uptrend, right? And
Perfect.
and so at this point in time, we're considering an uptrend. Once we start seeing bullish candle, bearish candle break,
Yep.
keep going down. Okay, so at this point in time, we're unsure. It's like this is not giving me enough evidence, confirmation, whatever. Now we start coming back up. As soon as we get this candle here, as soon as we start rejecting this level, not at this point. At this point, I'm not thinking downtrend just yet. But as soon as I see this wick rejection off of this same level, now I'm starting to think to myself, okay, this is starting to look like up, down, down, up. I'm starting to see that, right?
Right.
And so at this moment in time, you can absolutely assume to yourself, okay, we might be starting to trend to the downside a little bit.
Yep. So my question, so once you took that sell,
Yep.
and then I see at the bottom you took a buy. So
Yes.
What was that shift from when you already determined that the trend is down, but then you see that bullish candle close, and then you take it?
So, I mean, look, man, you have free reign to trade from the tops down or from the bottoms up. And what I want you to notice in this example, besides, yes, the trend is your friend. Yes, you want to be following it with it. And more oftentimes than not, I find the best trades that way. But that doesn't mean that you won't get reactions from previous lows and that you can't come back to the previous highs. And now, and even let's just say, let's cross all this out, right? Let's just say that this market, let's cross all this out. Let's just say that this market continued going bearish afterwards, right?
Yeah.
Let's just say, even though the trend is bearish, everything is bearish, notice how you still made money on the way back up to these highs and it rejected those highs. Now, this will not always happen. Sometimes, right, price will come back and it will create a high here. And now you're kind of stuck in limbo. And this is gonna bring me into my next point. And this is actually such a good segue into the next point. I got to start moving through these questions a little faster. This was one of the most important ones, but I'm gonna start going here. But price might come back here, right? Once price comes back here and starts rejecting this area, let's say, then it starts going down again and it stops you out. And then you say to yourself, "Oh well, I bought off the lows. The trend was to the downside when I bought,
Yep.
and I managed my position more aggressively. And once this candle closed bullish, this candle closed bullish. If the next one wants to go bearish, I'm already break even on the trade. I don't care.
Nice.
You know. And from here, you could be less aggressive with it and say to yourself, "Well, I have the trend on my side. I have everything showing me evidence that it wants to go down." So I'm going to be a little bit more loose with my entry, with my stop loss placement, and with my targets, and then also my break even. In this case scenario, you're going to be more aggressive with your entry. You're going to be more aggressive with your stop loss because you want a tighter stop. You want a tighter entry. You want tighter targets. Everything in this trade, for it to make sense, to be profitable in our system, we have to have the sleekest counter trend trades that we can. So it's like sometimes when you see my counter trend trades, it's like I enter very quickly sometimes. And those are either like quick stop loss or quick take profit and like no in between. And like, whereas these are the bread and butter. I had a 5 pip stop on this one. I had a 3.5 pip stop on this one. I mean, you know, as you practice the discipline with the trades that you're looking for now, Sam, like I know that you said that you're very, very disciplined and specific in the trades you take. I want you to stay like that for a while. Like stay like that for a while. Don't get upset about the trades that you see that you miss. Just jot them down. Jot them down. Learn from them. Because there is going to come a point in the next few months, next even year or whatever, where you're going to start saying to yourself, man, I am missing out on so many of these trades. I've been seeing it for the last year. Every single time. Then you're going to start taking them and telling yourself, man, like, this is fucking awesome. Like, I knew it. But not until you have that, like, aha moment that you're like, I have been seeing this. I have been jotting this down. I could have been taking them. You know, it's as simple as just even leaving a position on your trading view and like looking.
What's been working for me? What's been working for me, just from that example that you showed, rather than like trying to add into the third point within the 3 points that you gave for an A+ setup. What's been working for me is that exact same second example where my main focus is I'm just buying and selling off of key levels.
Yep.
And as long as it has range, those are the two confluences that I've been doing just to keep, because you say that all the time, keep the process the same. Just find a simple, easy way to enter the market that's consistently the same way. So for me, exactly that example, that second one that you gave is what I've just been doing. Just waiting for price to get to a key level, waiting for a reaction, which is a rejection. And as long as it has range, I just keep that process just like that.
Yeah. And that's really, at the end of the day, that's why I boiled this down. And, maybe some people will look at this and be surprised. It's like, that's, like I thought you were going to say something else. It's like, no, you just need range. Rejection as in, bearish, bullish. You want to enter as soon as you can, and rejections always help. And then these turning points. So like you said, the turning points, essentially what it is, it's a key level. And so whether it's creating its own key level, whether it's respecting a previous key level, whether it's whatever it is, it's turning and it's starting to go in the other direction. And as long as you have these things.
Sometimes. So that's why for me, just to eliminate the third point of the subjectivity for me, I just wait till it gets to a key point. And as long as I have range and then the rejection, which is like the first 2 points, as long as I have those first 2 points, the third one, I try not to overthink it. I just focus on a key level.
Yeah. You don't want to like try to decipher whether it's an uptrend or downtrend for an hour here sitting. Like,
I can get very subjective
very subjective. And especially like, looking back on past data, looking at new information, it can get very subjective. And so that's also why I try to zoom into the charts as far as I do, because it kind of takes a little bit of that subjectiveness out when you're so zoomed in. When you look in closer, it's like, yeah, we could say whatever was happening here to the left, but at this moment in time, rejection. To me, that looks like a double top. Pretty cool. Maybe we're gonna keep going down. Simple. And that's it. And it's like, it's just current action, current like patterns that I've seen before. And like, I'm sure you've seen double tops so many times before. Then you look at this, it's like, okay, this kind of looks like a double bottom, but I know it's following a double top here. And I know that we're trending to the downside. So it's like, I know we're counter trend more than likely, but I'm still going to try it. And it's like knowing that it's counter trend in the back of my head, more aggressive with my entries, stop loss, take profit, everything. Done. Just take the trade, walk away. And so this now leads me to my second point, which is when to go break even. And now I have included this little mock-up right here, and I hope you guys can see this. And so essentially what this is a... Here, let me zoom in on my iPad here. I have my iPad in front of me, and I'm marking this stuff up. So what I tried to do here is that you guys see how I have shown orange lines, and then I've shown red lines, right? You have red, you have orange, you have purple, you have white, you have gold. And so going back to what I was saying before about these inflection points, right? These points in the charts where price gets to and then starts turning, so on and so forth. How you go break even, and the best way to go break even, and now I'm going to start erasing some of this stuff because it's getting cluttered, but let's just use the entry of this specific trade that I have here and how I would go break even. And so this is your entry signal right here. This is the candle that entered you in, broke the high, continued pushing up, and then immediately, this happens to me literally all the fucking time, I'll have the most beautiful candle to push me into the trade, and as soon as I'm in the trade, it comes back and retraces a little bit. I don't know why. It literally does this every single time. Like 90% of the time that I enter a trade, it'll have like the nicest push candle into the trade, and then as soon as I'm in the trade, it just starts rejecting and coming back. But that's completely normal. Now, once price breaks this high right here and makes this new high, you are safe to move your stops behind the previous low. The next thing that we look for, and so notice how this stop loss placement, what I would do is I would be very generous with it. I would just bump it to half. It's a little bit lower than the candle. Yeah, you could probably make it even higher, but to be honest with you, I give it a little bit of space. You know, we're looking at gold right here. Gold has higher spreads. We're talking about 1.2, 1.3 spreads, and sometimes they could love to leave big wicks. And if that wick just comes right there and stops you out, you're going to be very upset about it. So give yourself some room. Always give yourself some room. Never be greedy. You know, don't be overly generous, but don't be overly greedy. If you look at the spread and the spread is 2 pips, give yourself 2 extra pips and just call it a day. Find the lowest point in which you find this wick here. And from that, give yourself plus 2 pips down. Oh boy, the typing looks a lot better on my iPad than the screen, but that's okay. So next part is now we're going to wait for the break of this high. When does the break of that high happen? Well, the break of that high happens right here. And what created that break? This created that break. And so at this moment in time, we can more than happily set our trade to break even, or even give it a little bit of profits to cover commissions and spreads. Now, once price makes this new high, we know that this is the low that we want price to respect to continue going up to the upside. Now, once price breaks this low, this is our new low, and so we can move our now stop loss. Let me make this red. We can move our stop loss here now, after this high is broken. And so on and so forth. And so this will continue going like this. And now the main point that I want you guys to be seeing here is that this is all price action dependent. And so the reason that I'm moving my stop loss, the reason that I'm cutting my trade to break even, it has nothing to do with what percent I'm up on the trade. Right? People love to say that. People love to do that where they're like, 1R, I'm going to go break even. 2R, I'm going to go break even. 2.5 hour, I'm going to go break even. To me, it doesn't make sense because in this case, let's just say that this entry candle pushed up to 1R. And then if it touched 1R, in the back of your head, immediately you would be saying, okay, I need to set this trade to break even because it's at 1R. I have to set this trade to break even right now. It's at 1R. And then exactly what would happen after is price would come back down, right back to your entry. It would stop you out at break even, and then it would continue going higher. And so that rule to me doesn't make sense. The scariest part about this trade is when you get entered, you're in profits, and then you're immediately in drawdown. This is the scariest part right here. This is the part that causes everybody the emotions and the holy shit, what's going on right now. You enter the trade, you go up, and so your emotions are really high. Then it goes right back down into drawdown, so your emotions get really low. And then it starts going back up again. And then now you're like all over the place. You're like, what the fuck's going on? And so you have to exhibit patience. And what I mean by that is this is a simple price action uptrend. I mean, look at that. Look how clean that is. And so once this happens and breaks and makes a new high, move the stop loss. Once this happens, breaks, makes new high, move the stop loss. Once this happens, breaks the new high, makes a new high, move the stop loss. It's really simple, guys. It really doesn't take much to go break even. And this is how I always do break even. And now this is on the 1 minute chart. Whatever your entry time frame chart is, you want to do it on that chart. You don't want to do it on your 15-minute. Another form that you can use, actually, and this is not the worst, but what you can use is you can use the 15-minute candles, the 30-minute candles, the 1 hour candles too. And so let's say you have a big bearish candle, right? This guy's name is George over here, right? George is a big engulfing bearish candle. And then we have Rob over here. Rob is just a nice little suspicious bullish candle. Actually, I'm not going to color him in because he's bullish. And so this is a high that we have here. And we're trading this next upcoming candle. And so that candle first comes down, makes the wick, now starts creating its body, and closes something like this. Right? It closes with a wick that touched the highs. I'm not extremely comfortable in the next candle, but I don't want to close because we are bullish and we can continue going up. And so my stop loss is behind this wick. I know, and behind this wick, what I mean by that is, these lows, you have to see how like this low right here, that low is, I don't know if you could see the higher time frame candles here, but that's the wick of the candle. This is the body. And that bottom part is the wick. And so exactly what it created there when it was creating that low, right? When it was creating that price action, when it was creating that 1 minute structure, whatever you want to call it, this low, this inflection point, this turning point right here was actually the wick of this 15-minute candle. And so once it breaks the high, which is the wick of the previous 15-minute candle, this is the wick of the previous 15-minute candle, which happens to be the high. Once it breaks that wick and creates a new high, we're now moving our stop loss to break even. So notice how this 1 minute structure, this philosophy we have with price action on the left here is the same exact thing as the right here, where we now move our stop. First, when we enter this trade, we move our stop loss behind the 15-minute candle. Let's just say that the next 15-minute candle opens and closes like that. I'm going to move my screen up here. Closes like that, right? Now we can comfortably put our stop loss behind this wick, behind this body, behind this body. It doesn't matter. But you're managing your risk. You're taking your risk off the table. You're using strong points within the charts to have your stop loss under. Because I'll tell you why this is strong, right? In these candles, the number one area that you want to be watching for. You want to be, okay, so I'm going to draw a candle here on the right. This is a bullish candle, right? And the next candle is opening, right? When this next candle opens and starts going bearish, let's say, the first area you want to be looking for is the previous candle's body low. If this candle starts breaking the body low, there's a very, very, very high chance that it's going to continue going down. Once this candle starts breaking the candle's wick, previous candle's wick, in the opposite direction, then there is an extremely high chance that the candle will continue going down. And so the two areas that I want to look at is the wick. Whoa, that arrow just drew really nice. That wick and that body. And so this candle, if it's coming down, it's not breaking the body. If it's coming down, not breaking the wick, that's giving me good signs that it's going to continue going up. As soon as it starts breaking these, it's giving me signs that it's going to go down. And so this is one basically philosophy that you can use, whether you use the price action here on the left or whether you use the candlesticks here on the right. These are two great ways to move your trades into break even. And further than just moving your trades into break even, trail your stop loss. Trailing your stop loss and getting more profits. And like in this case, you could have trailed safely basically all the way up until you were at 3R. And I can't remember how far this trade went. I'm sure that I took it out at 3R. But in certain circumstances, you can get 4, 5, 6R this way. And now, yeah, that won't happen often. More times than not, you will be unluckily stopped out. And, you'll trail your stops to 1.5, but it'll break out, break back in. And you just got stopped out at 1.5R. It happens, right? But the times that it does work perfectly, you'll have some really banger trades. And those will make up for most, if not all, of the 1R trades that you took, 1.5R trades that you took, the ones that didn't go all the way, the ones that stopped you at a break even, whatever. This is a game of survival, right? And this helps you survive so much. You don't think about the profits right now. The profits will come as long as you survive. And so you have to think about survival first. And so that was 43 minutes for the first two questions. We're going to start going a little bit quicker here. And that was the first two. Now, number 2, growing a small account, how to grow account properly with a focus on monthly, weekly targets, and when to stop trading for the week when a certain percentage hits. So growing a small account, I'm going to show you something very important here. And I've brought this up before, but I have three charts here, right? And so I'm going to explain these 3 charts a little bit here. And essentially what they are, these are equity curve simulators. Now, I don't love using these equity curve simulators, whatever you want to call them, but I do love statistics. I do love math, and I'm a firm believer that averages and means will always play out to be what they're supposed to be. And so, if you have, and this will go back into data collection and really just knowing your numbers. Because at the end of the day, this whole entire Forex industry, this whole Forex game, this is a numbers game. And so you're going to have to play the numbers, you're going to have to play them right, and you're going to have to play them fucking well if you want to make some money in this game. And so on the left here, we have a person A. Person A has a 30% win rate, a 1 to 3 average win. He started off with $1,000, and this is 100 trades. And so looking at this, and this is 100 different lines of 100 different people doing this. In a hypothetical statistical environment, right? You have a 30% win rate, your average win is 3R, and you're starting with $1,000, right? Your average biggest drawdown, this means that you could have a 15% drawdown. Your average max drawdown is 13%. The maximum is 32.8. So there are some people in this chart that had a drawdown of 5%. There's some people that had a drawdown of 13%. And there was some people that had a drawdown. Oh, shit. Sorry, guys. Then there's some people that had a drawdown of 32%, right? This is risking 1% per trade. I forgot to put that on here. I'm sorry. 1% per trade. And so with that 30% win rate and 1 to 3 average RR, you're going to expect, they're saying 26 losses. I think that's a little fucking crazy. I've never ever seen that in my life. And so that's why I take this with a grain of salt. But this kind of gives you a general understanding, and especially using the averages and what you should and shouldn't be expecting. Because if this happens to you, right? If you lose, let's say 10 trades in a row and you're going based off a 30% win rate, more than likely that's pretty normal. It's like that could happen, right? Now, you taking 10 full 1R stop losses in a row without going break even, without having anything, I think that's where the problem starts to happen, right? I've had losing streaks plenty of times. And I've lost 4, 5, 6 trades in a row plenty of times. But I can't remember the last time I've taken more than like 4 full stop losses. It's like if I took 6 losses, I'm telling you, I'm not risking a full 1% on that next trade, on that 7th trade to try to make the money. I'm lowering my risk back down. I just lost a bunch of money. So I'm going to slowly try to grow it back up. And it's like, like they say, like it's not going to rain forever. The rain's going to stop. The sun's going to come back out. And so as long as you could survive through those losing periods, go break even when you have to go break even. Take those tough losses. Take those tough break even trades. Avoid the trades that you don't want to be taking. Then you will fall into being more into the higher echelon of these statistics. Your average max drawdown isn't going to be 13%. It's going to be closer to 7, 8%. And the more you work on that, the more you're going to be able to get better at it, essentially. And now look at the difference here. The difference here is going to be a 35% win rate, but a lower RR. So your win rate's a little higher, but your RR is a little bit lower. So you might be a trader. This is also risking 1% per trade. So you might be a trader that per trade. And this is all going to tie together in a second. And so just bear with me here. You could be a trader that goes for bigger stop losses, smaller targets, but you're a little bit pickier with your trades. And yeah. And so your biggest max drawdown is 23%. Your average is 10. You make a little bit more money and you have less losses in a row. And so you could see the difference here, right? With making these small adjustments, being a little bit pickier, but a little bit less RR, you might be making a little bit more. You might be taking a little bit less losses, and you might have less consecutive losses and consecutive winners. Now, going over to the last one, which is my statistics, right? I have like a 39 point something percent win rate, 38, 39. I just made it 40. I rounded up, right? Let's just say I start with $1,000. Let's say my average win is 1.27. That is my average win. I try to make it as close to 3 as possible, if not bigger. For this year so far, it's been around 2.7. I've taken a plethora of 2.5 hour trades, and that kind of lowers it. So biggest max drawdown, 23. My true biggest max drawdown, which I went through actually 2 days ago, is 13%. I went down. It's not. Why is it not rating? It'll start in a second. My biggest drawdown is 13%. My performance on the account, it says, I'm looking at the wrong one here. My biggest drawdown was 13%. Max consecutive winners, 6. Max consecutive losers, 5. This 13% came from these 5 losing trades and also risking too much and being a dumbass. So this doesn't make sense when you're thinking about this whole entire statistics thing. And this will change for you. But what I'm trying to display here, and what I'm trying to tell you guys, is the importance of numbers in this business. It is so important to understand how you're trading and to actually collect those numbers now to have an idea of what you should be expecting in the future. Right now, you guys want to be learning as much as you possibly can until that L starts to become silent. And I think you guys know what word I'm talking about here. And so you want to slowly start collecting that data, and you will start getting a win rate number, but that number is not going to matter. But what that number is going to tell you is, okay, this is where I should be lining up my risk. This is where I should be starting out. And so now to go into this question a little bit further of a $1,000 account, right? Let's just say you start with $1,000. Let's just say you start with $5,000. Somewhere around here. I personally did not risk when I started with 7K. Each trade I was taking was from $70 to $150 each of risk. So I was quite literally risking 1 to 2%. And I didn't even do that on purpose. I just wanted to have a low enough risk so I could make some money and not have to worry about it too much. And so I was quite literally risking 1 to 2%. Now, as my account grew, my risk grew. But how did my risk grow? My risk didn't grow because now I started risking 2 to 3%. My risk grew because now my account went from 7 to 14,000. And so now my risk is $140 to $280. And notice how that is still 1 to 2%. Now, this process here to go from 7 to 14 took me about 2.5 months. Now, the process to get me from 14 to 28 took me about 1 month. When I got to 28, now I'm risking $280 to $560. Still 1%, 2%. This doesn't change. Right? I don't want you guys to think that I'm out. I've risked a lot more in the past. And I've had a couple of personal accounts, and especially towards the end of last year, I was risking like 4%, 5%. And it wasn't working very well because I would take 3 losses in a row, which is pretty common for me. And I take 3 losses in a row and I'm risking 4 or 5%. That's 15% of my account gone. The biggest drawdown I had here was 13%. And so all this factored in. What I'm trying to say is that you guys want to start small and keep it small. The point of going bigger, the point of getting bigger is when your account starts to grow. And now when you're at this level 1, level 2, 14,000, 28,000, what you can start doing, and this is what I did on some trades too, when you see a trade that you think is very beautiful and you think it's amazing, you risk $400 or you risk $350. A little bit more, it's like your 3%, 4%. You already double your initial starting balance. Even if you lose, you're going to be up 13.5. Not a big deal. And so now you could start taking that risk. But notice how these first 2.5 months of just grinding this account 1%, 1% at a time to get it up to double its size, that's the part that takes the longest amount of time. And you see the least amount of returns from it. Now, if you start this with $1,000, let's say, right, your days are going to be looking more like $10 to $20. That 1,000 to 2,000 mark is going to be your 2.5 months. You're going to make $1,000. And this is why I'm saying it's so important to get a job and so important to fund your personal account somehow. I do not want, if you guys are trading on your personal account and you're doing this for the long term, I really don't think you should be risking more than 1 to 2%. And even now I'm sitting around like 110K. I've kind of hit a plateau, and I'm having a hard time risking $1,000 to $2,000 per trade. Well, $1,000 to $2,000 per trade. it's so abnormal for me to do that with my own money. It feels so surreal to me, and it's just like I don't even know if I should really be doing this. And like 1K right now for me, every single trade feels like a lot of money. And so you guys will hit plateaus, you guys will hit areas where you're going to be like you're going to have a roadblock to get over. And to get to this point, you have to go through this. Everybody does it. I started here because of my job, because of my work, because of the money that I saved up, because of everything. And, and I even built it up towards like 13K. I think I put 13K withdrawals, or not withdrawals, deposits into that account. Actually, no, I did. It was like 11 or 13K, whatever. It doesn't matter. But I started here. If you start with $1,000, this is where you're going to start. And, you're going to have so much temptation to go $50. Doesn't seem like a lot when you have $1,000, right? You're like, oh, $50 is not a big deal. I promise you that $50 will affect you way more than you think. Because the $50, immediately you see $9.50 in your account. If you see $9.90, hell, you'll probably start, if you invest $1,000 into an account, buying Bitcoin, transferring it over to your broker. When you first open the account, you're probably going to have 993 in it with a couple of cents, 41. You're not going to have a perfect $1,000 because that's just not how it works. Like you're going to have to pay for Bitcoin transaction fees. You're going to have to pay a broker to buy Bitcoin. You're going to have to maybe pay your broker fees. You're going to end up with 993 in your account. You risk $50 on your first trade. It's going to end up being $60 with spreads and commissions and everything. Now you're down to 930. Now you're like, oh shit, let me just take that one other trade today because I feel like this one's really going to hit. You risk $70 this time. Now you're down to 860. Now that $1,000 that you just took out of your bank account is at $860. You're like, how the fuck did that happen? And it happens so fast and it happens so quick. And that's what I'm saying. When people ask me to risk more on trades, when people ask to risk this amount, that amount, you have to be extremely cautious. And so people always come from the place of neediness and greed, right? When you first start, the first deposit you make, you get really excited. You're like, hey, I'm going to make a lot of money. This is going to be great. This is going to be awesome. I'm so excited to start this new account. I just took my $1,000 I made and I'm putting into my personal account. This is going to be great. Whereas that first $1,000 you take, it needs to feel like a savings account. You don't want to touch that $1,000. You want to start playing with their money here on the right-hand side, that money that you make, as soon as you freaking can. You want to take that $1,000 and make it 1,100 as soon as you can. And I'm not asking you guys to flip the account to 5K right away. I'm saying get it to 1,100 as soon as you can. Then from there, you're going to go back down to 1050 and then you're going to come back up to 1,200. Then before you know it, time will pass and you will be at that 2K mark. And what this process of the 1,000 to 2K will do, it will open up your eyes. And as soon as it opens up your eyes, you're going to start saying to yourself, okay, I don't need to trade more. I don't need to do more. I need to make more fucking money. And now how do I make more money? I add more money to my trading account. How do I add more money to my trading account? That is up to you, my friends. Sales, jobs, whatever the fuck you want to do, you add more money. There's no quick way. There's no fast way around this. It's all a slow burn process. Depending on how much money you start with, that's how much money you're going to make. And it's like now I'm starting to get to the point where okay, I'm sitting around 100K. I know people sit on $3 million accounts, $10 million accounts. I have friends that have hundreds of thousands of dollars in crypto invested and it goes up and down and whatever. And it's a pretty surreal feeling because it's sometimes when I hit a banger trade, it's that could be more than I make at a month at work. I'm starting to get to that point where one trade is becoming almost as much as I'm making at work. And it's like, to me, that's a pretty fucking crazy feeling. And it's like, I haven't touched this money yet. It's still just sitting there, and it's just basically a savings account at this point. And I'm just saving as much as I can, protecting the capital, risking 1 to 2% and slowly growing it. And you know, the time it took for me to make $1,000 before, from 7 to 8,000, took a while. Now to get from 110 to 120,000 is going to be way faster, because the compounding effects, everything starts to just grow and grow and grow. And so, to bring your question home here, this one didn't take too long. To bring your question home here, start small. Start really small. And slowly grow on top of that. Know your numbers, journal your trades. This is where all of this becomes very important. Because when you're trading on a prop firm, you're basically taking, 15, 20 trades to pass. Those 15, 20 trades could be on the left or the right side of your statistics. So you could have a 45% win rate during the challenge, or you could have a 35% win rate during the challenge. Once you start trading on a live account, that's when your win rate's going to be closer to what it actually is. Because you're going to have a lot bigger volume of trades on the same account with the same numbers over and over and over again. And so when it comes to monthly and weekly targets, this is going to sound weird, but I don't have any. My targets for the week and for the month and for the day even is to follow my process to a T and take every single trade that I see that is good and do not over risk. Do not over risk. Keep it 1 to 2% and take every good trade. This is the one part that I have, which I don't think you're going to like in this response, Sam, but I have a little bit of an intuition when it comes to this. And if I don't feel good one day, if I had an argument with somebody, or if I had a very long day at work, or if I didn't get good sleep, or if something happened and I'm not on my tip-top shape A game, I just will not trade that day. If I am in good health and in good shape and in good everything, and I come to the charts and I'm just not seeing something, I will not trade that day. I do not need this money. It's not that I need this money to survive. I want to be able to make a lot of money in trading. I don't need it. And so there's a very big difference in needing and wanting. And me wanting this becomes something that I'm just going to slowly grow over time. And if I don't trade this week, that's fine. I know there'll be next week. And it's like, I've put in so much work this year already to trading and not to trading. And it's like, I've taken plenty of weeks off. I've taken plenty of days off. I've taken plenty of everything off, and it's fine. And so the days you don't feel like trading, don't trade. The days that you do feel like trading, there shouldn't be a cap. Because whether you don't let yourself take 6 losses, because there's a possibility those 6 losses may have all been good trades that you should have taken, and it's just a statistical probability that happened. Or what's more likely is that you took the first 2 trades, you started getting pissed off, and then you started revenge trading or over trading and taking bad candles, and you took 4 more losses. And so there's a fine line between the two. Taking 6 statistical losses in one day is very improbable, but it can happen. If that happens, then you're shit out of luck. It is what it is. You took 6 losses in a day. What I think is far more likely to happen is that you're just doing something stupid and you're over trading, you're using your emotions, and you're not thinking logically. And so, I personally don't have a percentage target. I don't have a weekly, monthly target, because I'll have a minus 1% month, and then I'll have a 55% month. How can I have targets? How can I have goals when it comes to this? It's like my trading is so sporadic, not because of me, but because of the markets. And so you can't look at your results as a dictator if you're doing stuff right or wrong. You have to use your process and your reviews and your trading as to whether you're doing right or wrong. And so this is why I think that the whole trading journal is so fucking important. And I'm working on getting my trading journal actually up and running for you guys completely. I made a whole new Excel. I made everything. It's still not all fully set up yet, but I'm working on it, and this is going to be great. But you have to take things with a grain of salt, and you have to just take the good trades. Take the good trades and focus, be process oriented. Do not be results based. As soon as you become results based, I mean, bro, you could have a losing week and taking the best trades all year, but it's still a losing week. And so now you're going to come back to yourself and you're going to base your results on the week, and you're going to say, oh, well, all these trades were horrible because this was a losing week. And then you're going to come back to yourself, and then you're not going to want to take those trades in the future because you said, oh, it was a losing week. I remember that week. It was a bad week. I'm not going to take these trades anymore. And then you're going to stop making money on those trades. And so you have to be process oriented. You have to look at the trades at a high level and just understand to yourself, okay, these trades were good. I lost on them, but do I continue taking them? Yes. Did I do everything that I was supposed to do? Yes. Did I over risk? No. Did I wake up every morning? Yes. Was I in a good mood every day? Yes. See, these are the things that matter. And so I wouldn't have concrete targets. And I hope that whole question makes sense, but I really wouldn't have concrete targets. And this will kind of come into this in a little bit. I hope you guys are enjoying your...
Nice. Thanks, bro. Well explained.
Yeah, I mean, do you have any questions on that?
No. I actually loved what you said, actually, about if you don't feel good within a week, you don't trade. Because just last week, you know, like even in the chat, I'm usually like very active. I was kind of quiet, just kind of being very patient. I avoided a lot of losses, but I wasn't really like locked in on the chart just because I was really focused on finals. So I knew, all right, this week, I'm just not going to be able to give my 100%. And it just happened that I got lucky that I actually, you know, avoided a lot of losses. But my whole mindset during that week was exactly what you said. You know, I'm following the process, and right now I'm locked in somewhere else. So I'm just not going to force trades. So I actually love that you drove that point. And as far as like weekly targets, I always thought that if I'm trading and I'm up like 10%, I should just stop for the week. But I feel I understand what you're saying, because then I guess that stops that process of being consistent, of just your process is once you see a high probable trade, you're in a good mood, you're coming every day, and you're just basically just locked in. So I see how you're growing the accounts within 1 to 2 months with just staying consistent like that. So thanks, bro.
Yeah, of course. And you know, and you're gonna find out that like sometimes it happens a few days before where you're like, this week is gonna be tough, and it ends up being tough. Sometimes it happens the morning of, and you wake up, you sit down at the charts, you look at your computer, and you're like, fuck this. And it's like the more you do it, the more you get in tune with yourself. And I'm sure you're already fairly in tune with this if you've been doing it for a long time. You know, you'll see that you just sit down at the chart sometimes. You know, and it was supposed to be a good trading day. It was supposed to be high volume. It was supposed to be news today, and you know you were happy, you were looking forward to it. But something is just wrong. You woke up, you woke up on the left side of the bed. You were just like, fuck this. You sat down at the charts, you weren't feeling it. And it's like, close up shop, do something else. It's like, it's not, you can't need this. You can't need trading. It's like jobs, work. Okay, you need to wake up for work. You need to go to work. It's good. It's good for you. But trading, you have to think in the opposite term. And so it's very good, bro. I think that's a very, very good trade to have. And, you know, being consistent, and, you know, with the targets, even if you make 10% this week, you have to think like a fucking robot. Don't even look at your P&L. You have a process. You know that process is profitable. You know that it's going to continue being profitable. So if you see those trades on the charts, you take them, and you don't even think about the money that comes along with it. The way that you're going to really level up your trading is by stopping to think about the profits, stopping to think about the money, because this comes in winning and both losing. It's like winning is not easy either. People think losing is hard. I think winning is harder, because once you start winning, then you start getting greedy, and then you start saying to yourself, should I withdraw this money? Should I start risking more? Should I just stop taking these trades for now because I've already made so much? It's like, is this going to keep working for me? It's like you have to eliminate all those thoughts and just like If you see the trades that you're supposed to take, you take them. And, you know, in the beginning too, I think that the reason that people set these targets for themselves is because you'll get kind of like a how do I call this, like a blind eye, if you will, where you start getting into this state of like euphoria where you're just you made 10% this week. That's a great week. And you're happy, everything's good. You look at the charts, you kind of bring that same energy into the charts where, like, when you bring energy to the charts, it has to be neutral. It has to be good, clean energy. It can't be negative, it can't be positive. It just has to be neutral, unbiased. You're seeing information and you're trying to do your very, very best of understanding that information without any biases over it. You develop a bias after you look at it, but that can't be influenced by your energy. And so that going back to that point, if you make 10% in the week, that energy that you're starting to bring to the charts is extremely positive. It's extremely up. It's extremely high. You're going to be very, very quick to take trades. You see the trade that you want, you enter it fast. You might be more aggressive with your stop loss because you know it's a good trade. And see, you're not doing anything wrong. You're still taking good trades. You're still doing right things, but you're not being neutral. You're not being unbiased. And so that's something that I would go back to and kind of rehash over. Like, you know, the same way that you're having bad days, bad weeks or busy, you know, days or whatever, and you're taking a break, you could do the same with winning. If you see yourself, you had a great week and you want to call it a week, call it a fucking week. And it's like, that's the way to do it. Don't do it based on a certain percentage that you hit, because let's say it's 10% now, and then you get to that 10% this week, and then you're going to be like, oh shit, like that was a crazy week. I remember when I had my first 10% week and I was like, that was a crazy fucking week. A couple months go by, I had a 21% week. And it's like, if I limited myself to 10%, I would have never had the 21% week. And now it's like, I haven't even came close to that in the last 7 months. But every 8, 7, 9, 10% week that I have had in the last few months, it feels like a good week. It's just, it's good. It's, you know, it's not over the top. It's not, because I know I can do better than that. And I know I have something to beat. And so I don't limit myself. I don't cap myself. And so I hope that long-winded example kind of makes sense. And yeah, and you just got to focus on the process, man. That's how you're going to grow the account. You know, growing the account is focusing on this stuff, the minute stuff, the small stuff, the break evens, the A+ setups, finding good candles, risk management. You know, risk management feeds back into break even. And it's really about just connecting the dots. And so everything that I say, everything that I go over, it's about connecting all this stuff and putting it together in a form that you're going to be able to use very well. And so that takes a little bit of time, but it happens. It happens, man. You just got to keep trying, keep doing it. And it's going to click, and you're going to be like, whoa, this makes so much sense now. And then the only thing that you're going to be fighting with after that, the only thing that's going to be pissing you off is time. And I'll tell you that right now. You're going to be like, damn, this just takes a while. And it becomes work. And then it just becomes a daily process of doing the work, showing up to the charts, taking the trades, continuing on with your life. And it's a beautiful thing. So now we're going to go over some trades that I took. These are August 6th trades that I took here. And so surprisingly, I took a NOS buy on the 1H. You know, I don't love the 1H too much. I don't take many 1H trades. But for some reason, I saw this trade. I really, really liked it, and I said I was going to take it. And so basically, simple thought process here, right? We have price creating a downtrend. We have support formed. We have a reaction. We have a lower high formed. And we have a lower low, right? And so in this moment in time, oh, why is this not syncing? Come on. Is it gonna work? Okay, well, oh, there we go. Perfect. So yeah, so we have a lower high, lower low, right? This is our lower low down here. This is our lower high up here. Now, as soon as price, and price does this a lot, right? It'll be in a downtrend. It'll make a lower high, and it'll start failing to break that lower low. And so in this case, two things can happen. Price is either going to continue shoot down, or it's going to shoot back up. And so knowing this, knowing this information here is that we have this low. It's failing to be broken once, or it's made. Once it's made, this is when it's made. Then it's failing to be broken, failing to be broken. This is all also on the 1H time frame. Right? 1H time frame, what that means to me versus the 15-minute. This is 4 15-minute candles. 1, 2, 3, 4. And there was probably some bearish and bullish 15-minute candles in there. But this is 4 15-minute candles in this 1 hour candle. And so that's giving me more confluence that this level is really failing to be broken. And we have a little bit of range to the upside. The wick was made first. Entered on the flip. Stop loss below. Simple. I mean, there's really not much to this one. This one's not the prettiest trade in the world. I took this on the 3-minute. I probably should have taken it on the 2-minute. I didn't enter right away. I waited for this bearish candle, placed my buy stop above. I love this wick. This sustainability that you get right when the trade opens. This is what I'm looking for every time. This wick, this bearish candle wick, this bullish candle wick, that's some beautiful, beautiful, beautiful stuff right there. Because seeing this sustainability right when that candle opens, that just shows me that that candle is, oh boy, that candle is opening. Sorry, that candle is opening, and as soon as it's opening bearish, it's really rejecting that. It's trying, and then it goes down a little bit further, and it just rejecting that again. This is as soon as it opens, and then this is how it closes. As soon as it opens, and then how it closes. And so what this is showing us is that, hey, they're trying to go down, it's failing, and it's coming back up. And so if you see that sustainability right when that candle opens, that's some great stuff that you want to be looking for. Sustainability. In this case, we didn't have much range to the upside, but I really liked the price action that I was getting on the 1H time frame. We're failing to break these lows. We're showing that sustainability. We're starting to trend to the upside. I like my stop loss placement. It's near the lows. And I think we can hit 1 to 2. And so I took this trade. It's a simple trade. I mean, we had a little bit of range to the upside. Bullish candle right at one of those inflection points, which I was talking about for your A+ setups. And I don't even remember how I managed this trade. I think once this high was broken here, I'm pretty sure I moved my stop loss there. And that's how I managed the trade. It's just simple. And that's the thing about these break evens. Just when it taps into this level here, I'm going to zoom in a little bit here and clean this up a little bit. So when this is our high, right? And this is where our current stop loss is. When price just taps into these levels like that doesn't make me go break even. What I want is a clean break above. So that would work for me. Once I see one of those 3 candles close, then I can confidently put my stop loss here. But price just tapping into this level, that's not going to cut it for me. I need a clean break above. I need a clear confidence that it broke above. And now once it broke up here, the rest is history. And that's it. Not my favorite trade, not my least favorite trade. I mean, hey, I managed my risk. I took the trade. I thought it was solid, and I would probably do it again. This one's much more pretty. Much, 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 much more pretty. And I think you guys can see that right from the get-go. We have a clear uptrend. Price came down. We have the inflection point. Like I said, sometimes you won't get full rejections, right? In this case, we didn't get a rejection, but we got 2 really strong candles, right? We get a strong bearish candle right into a strong bullish candle. And so this is enough rejection for me. if these candles closed here, let's say instead, and gave us huge wicks to the downside, same thing. And so I really like this one. And you have your entry candle here. You have clear range back up to the upside to go break even, and you have the trend on your side. And so what did the 1 minute structure look like? The 1 minute structure was not the cleanest, but not the worst. Price opens right here, comes down, shows us that sustainability, which I was just talking about. Let me zoom over to the side a little bit. Shows us that immediate sustainability, which I was just talking about, right? So let me just draw this again. We have immediate sustainability right after the first candle. We have a nice entry point, and then whether you wanted to put your stop loss here, 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 or where I did, I think that all would have been valid. And so I went with the more aggressive approach, and I think that this was a fair amount of stop loss range. Let's wait, hold on, let me see. It's 49.82. 35 pip stop. Yeah, I was comfortable with that. So that's probably why I didn't make it any bigger, because this would have been like a 40 or 50 pip stop, and that's just very large for NOS for me. And so I took this trade and managed to break even here, most likely. Once it actually, I didn't even have anywhere to manage this trade, because this was our low, and once this high got broken, it didn't come back down to create another low. The first place I could have managed this trade is to put my stop loss either here or here once this break happened. But yeah, but that's the basics of that trade. Then we have this trade. This trade we just looked at a little bit ago, actually. Funny enough. We looked at this trade because this trade's interesting in the fact that we have a bullish candle into a bearish candle, right? And so the reason why I took this trade, right? So simple, we already explained this price action, but I'll go through it again. We have a high, we're rejecting that high, rejecting that high. This is starting to look like kind of a double top, right? Like a downtrend pattern. We could definitely continue to say that the downtrend might continue. And so simple thought process, I'm making a safe bet on what I think that is happening on the structure. And I'm saying to myself, after this candle closes bearish, I think the next one will be bearish and continue back down to these lows. Now looking at the 1 minute structure, this is where I got my whole entire evidence from. This is how to read 1 minute structure. And this is going to go into Sam's question later too, so I'm not going to do too much diving into it. But basically we have an uptrend, right? We have the break of the low happened. Price failed to come back, make a high. So this is our first signs way back here that we're starting to possibly go down. Now price comes back up, respects the previous high, comes back down, and this is where the candle started opening right here. Right? And so that's where I started making my decision of, okay, well, we just got the first signs that the structure may have shifted to the downside. If we break these lows and we support these highs, I think we can come back down to the bottom. And that's exactly what happened. And so notice how the candle that we traded, right? The candle that closed bearish was, I think, this candle, right? Or no, a little bit less actually. It was like something like that. That's the candle that closed bearish. This candle right here closed a little bullish, and then this is the one that we traded that closed bearish again. And so notice how even though this candle closed bullish, and this is why I think it's so important to talk about structure, the structure behind these candles was still bearish. So that idea of price continuing to go down, even though this candle closed bullish, does not matter. Your structure is still to the downside. The bullish candle just happened because we were getting this pullback, and it happened to be timed perfectly with the 15-minute candle closes. and that's why I closed bullish. And so we're still good to take this trade. And I noticed this as it was happening in the live market conditions, because I've seen this happen before, where before I used to be so disciplined and so patient that I would never ever take this trade. Why wouldn't I take this trade? Because the previous candle closed bullish. But seeing this happen over and over again, and this kind of comes down to like even like what Roger Banks says about impulse entries, right? You have a bearish candle, then you, and Raja and Rocks both talk about this. You have a bullish candle, and then you have another bearish candle. The break of this low is either your pause and go entry, your impulse entry, or what I like to call nothing, because I don't have a fucking name for it. So, sorry, I'm not fancy like that, guys. But this is just your typical setup, right? Your downtrend pattern. I mean, you know, this is basic stuff that you can buy in fucking Forex books and Barnes and Nobles. Like, they have this everywhere. And so, you know, the fact of me saying, oh no, but the last candle closed bullish, I can't take the sells now. I've noticed that that's been a little silly on my behalf. And because of my discipline, because of my patience with the trades that I have been taking for the past couple of years, I started now noticing these patterns and saying to myself, okay, I can do this. And so, yeah, so those are the 3 trades. And then I took one loss, and I'll go over this one briefly, because I didn't want to have all wins.
Hey, Mike,
Yeah, go ahead, man.
I don't mean to cut you off, but it's so interesting that you keep bringing this up on the pause and go, because it just dawned on me last week. I was in a trade, and the candle closed bearish. I marked my level of sustainability on the entry time frame, and I'm waiting for price to respect it, which it did. And as I'm waiting for price to go and break the low, I didn't even realize that the 15-minute candle already closed and it was bullish, because I was just so locked in on just my entry on the process. And I took the trade, and when I look back, I'm like, oh shit, like according to my rule, the last candle closed bullish, I shouldn't have entered. But I just started realizing this as time goes by, more and more and more, exactly what you're saying. So that's such a gem that I think a lot of us has to really go back and check, because that's amazing.
Absolutely, brother. I mean, it's so funny that you say exactly the same thing, because that's here. That's this right here, right? And basically, you know, when you really break down what we're doing in this whole strategy, we're scalping on the 1-minute time frame with breaks of the lows, stop loss above the highs, based on 15-minute structure. That's what we're doing. And so, you know, that bearish candle close, that's our simple trigger or indication, hey, this is the trade I'm looking for. So once we get that indication, that's when we start coming down to here and looking for these intricacies and saying, okay, this is the low, this is my stop loss placement. So all that I get from the 15-minute time frame is essentially just my target and my indication of a potential trade. When I come down to my 1 minute, what I'm seeing is my stop loss placement and my entry. Those are the 2 things I get from the 1 minute. I have targets and the indication of there even being a trade from the 15-minute. And so, you know, and you know, and that's why these 2 go hand in hand. And I think that's a wonderful thing to, you know, to realize. And that leads me into my next point. So that was a breakdown of all the trades. I'll go over the loss in a second, but I want to go into this point now. Rules-based or intuition-based, and how do I manage the 2? What you're essentially doing here is, like, if you had a rule that said, okay, last candle must be bearish. The problem with that rule, there is no problem with that rule. I like that rule. That's a fine rule to have. If you want to have the rules, that's fine. Makes sense. But the issue that I have with people having rules in the first place is that they don't understand why they're rules. And so this is where the whole like intuition / rules based thing comes into play, where if you understand what it is that the rules are actually doing for you, what it is that the rules actually help you with, why do you even have rules? Well, you might say 1% max risk. I'm going to ask you why. Why don't you risk 50%? Why don't you risk 2%? Why don't you risk 0.1%? Why are you risking 1%? Who said that to you? And why did they say it? Or why did you come up with that? And once you answer this why, that's when you don't need your rules anymore. I take 25%, 25 losses max. That's a statement that you make based on your data, based on the rules. Sorry, based on the trading that you've been doing, based on your data, based on your journal. You've seen that you've taken 25 trades max ever that you lost in a row. I'm just using a wild example here. So in this case, if you were risking 5%, you blow your account 110% of the times. 100%. If you're risking 5%, you 100% blow your account. So now this rule of risking 1% max is starting to make sense to us. We're like, oh, well, I can't risk 5% because if I do, then I'm going to blow the account. More than likely. Like, I might get lucky, but I'm also not a junkie and I'm not trying to get lucky here. I'm trying to make a business out of this. So I'm not trying to risk 5% and gamble my way up there. I'm trying to do this the safe way and actually get there instead of getting there quicker, but make sure that I actually get there. And so you start making these statements of why you do things. Then you understand why that rule is a rule in the first place. And then it comes back down to playing with it after. And that comes back down to the intuition part. When you understand why you can't risk 5%, then you also understand why risking 0.5% might be better. And then you also understand that risking 1% is like, okay, that's kind of the perfect in between. It makes a lot of sense now. And then you could say to yourself, okay, 25% of my account, I'm okay with going in that kind of drawdown. And then you could say to yourself, okay, if my prop firm has 10% drawdown, I should probably do 0.5% risk because if I take 25 losses, which is not guaranteed, then I might be down 12% max. So let's just say I go down 8% max this time, then I'll pass my challenge. And so none of this stuff is guaranteed, but this is all stuff that we come up with based on our numbers, based on our trading. And so these rules that we have in place, and like last candle bearish, and then I can only take sells. I just went into depth with that, right? What are we doing with the whole basically 15 minute, 1 minute? What are we doing? Well, we're getting a direction from the 15-minute candle, bearish candle, and we're trading the break of the low with stop loss above the high on the 1 minute. And so this is our 1 minute, this is our 15-minute. Now, this is the most simplest form of this that I could put it in, but you could play around with this. You can change this. And so what I want you guys to do is start understanding why you have rules in the first place. If you need to ask questions about it, ask questions about it. If you need to, change them, change them. If you need to adapt to them, adapt to them. But the number one thing I wrote here is, oh boy, there we go. Don't be greedy, manage your risk. Now, when you risk too much, when you're greedy, it's going to be really hard to understand some of this stuff because you're going to be clouded by your emotions, by your risk, by your funded account, by your personal account, by whatever. If you just lower your risk, it's going to solve most of your problems. So lower your risk, try to follow your numbers, and don't be afraid to change stuff up and adapt. And so that's kind of the main part I have here. And that's why I always go with the rules based or intuition based. And I'm proud to say that I use both. And it's like sometimes I will risk a little bit more than 2%. And now somebody's going to say, oh, why are you risking more than 2%? Because I fucking understand this. I understand this so well that if I take one trade at 5% risk, it's going to take me 2 or 3 1% trades to get that loss back. It's not going to blow my account necessarily in that one trade, but it has very good potential upside. And so if I did that a couple of times, I could have very good upside on it. And so, once you fully understand this stuff, you could play around and you can use your intuition more. And so that's what I mean by when I say intuition or rules-based things. And now this leads me perfectly into this next question. I like how these are kind of structured and set up here. Thoughts on risking more than 1% on challenges to get funded quicker rather than spending a lot longer? Of course, depending on how many trades you take generally, less trades equals more risk. First point, less trades does not equal more risk. Less trades, more risk. No, less trades does not guarantee that you're going to be risking less, if I'm answering this question correctly. If you take less trades, every trade that you take should be an A+ setup. To whatever you define an A+ setup as, whatever you think is the bread and butter, the perfect trade setup, whatever, that should be the trade that you're taking every single time. And so, technically speaking, if you just take less of them, the win rate on every single one that you're taking doesn't change. If it's a 40% win rate today, it's going to be a 40% win rate tomorrow. I mean, obviously, granted, it will change in the markets, but I'm just using like a very steady baseline here and saying, okay, let's just say you have a 40% win rate, then the less trades that you take will not alter that win rate. The more picky you are, you might actually fuck it up more because you're trying to be too perfect. You're trying to do too much. It's like if you just follow your process, follow the trades you should be taking, you don't try to look for the most perfect ones, you just look for the good enough ones and the ones that actually make sense and that you can use, then they won't mitigate your risk. And risking more, that's where this comes in play. Understanding how many losses consecutively you can have. Going into that equity curve simulator and really driving through your numbers, understanding what your numbers are, how your numbers work, how the statistical probabilities actually apply to your trading itself. And this is something that you can kind of go into more in depth by yourself, or, and if any of you guys have this question for me, as soon as you have more numbers, basically what we become data analysts of these numbers. And we try to understand these numbers and go through these numbers as much as we can and try to really figure out what's going on. And so risking more than 1% on challenges to get funded quicker with this strategy that I'm currently using, I think is extremely, extremely, extremely risky. If I'm going to be risking, let's just say 2%, right? I risk 2% on a funded challenge. Then I'm going to be down. I have basically 5 bullets risking 2% to make money. And what I'm trying to make is 10R. Let's just use 10 and 10 for this example. 10% drawdown, 10% profit, phase 1, one-step challenge, simple. And so I'm using 2%. So I need 2 winning trades, one at 3R, one at 2R to get to my 10%. And I have 5 bullets to get those 2 winning trades. And if I use 3 bullets before getting a winning trade, I'm still going to have to make up the drawdown first before I even pass the challenge. And 5 bullets is 5 trades in a row. I mean, doesn't happen to me frequently. Doesn't happen to me too frequently. Happens for sure to me personally, but I would be ready to lose the account. If you're doing that type of risk on a funded challenge, you have to go into that account saying like, okay, this shit doesn't mean anything to me. It's like I'm gonna risk my ass off, and then I'm gonna try to make a quick buck. Is essentially what you're trying to do here. And now I don't think that's wrong at all, and I've seen plenty of people do it, but that's just not my style. I'm the type of person that rather go for the $1 million funded account, risk 0.5%, risk 1/4%. Right? Like I'm trading on $1 million. That's $10,000 risk each 1% trade. Meaning a 0.25% is $2,500 on a trade. in the big picture of the account, I'm losing 0.25%. That means nothing. I'm making 0.5% to 1% per trade. That's nothing. But to me, risking 2.5 grand on a trade per trade is a lot of fucking money. And so the way that I would risk more is make more. Either make more money, put it into your live funded account and have more money to trade with, or go for the bigger challenge. Gain the confidence to buy the biggest challenge that you could possibly find and risk less on it so that it actually is more, right? That bigger account will amount to more risk for whatever you feel because of the size of the account. And so the 0.25% is a lot of money still. And they have $1 million, $2 million accounts out there. And so you can get them. And now, and I think that what is the main goal here? If you're going to go for $100,000 account and you're going to be risking more than 1% to make a quick buck, I guess in the funding stage, if you have $500 to blow just like that, and it's not going to really phase you, and you're trying to get funded as quick as possible, I'd say fuck the risking more. Just fucking do a buy stop, sell stop, CPI news on 2 accounts. Do 1 buy stop, 1 sell stop. So if you're trying to get funded so quick, and if you're trying to really just like not spend any time on it, just do buy stop, sell stop, news, 10% full leverage on the trade. You get funded on 1 account, you lose 1 account. Like, why not? It's like it really depends on what you're trying to do and understanding your numbers. And this comes back to this point of rules are intuition based. If you understand that you have 25 trades in a row, what the consequences of risking 1% are. You can lose 10 trades if you only have 10% drawdown. Now, the higher you increase that, the more likely it is to happen. And so if you understand that, then you'll know the risk is high. And if you're trying to play the risky gambly game, then I would do it full force. I wouldn't just put your toes in. I would put your whole leg into the water if you're going to do it. You either do it I don't want to say the right way, because I'm not here saying, oh, my way is the right way, but you could either do it the slow and steady way, or you could do it the quick way. And now I prefer the slow and steady way because that's just how I've been taught to trade and how I've learned how to trade. But I know plenty of people that fucking just go crazy.
Hey, Mike, can I add something to that?
Yeah.
I find for me what works best is whatever you're doing on the challenge phase, you want to kind of transition that over to the live account. So for me, like when I was like break even and it took me like a year, I was only doing like 1 trade, but I was able to kind of like what you always drive home. I was able to survive and stay for a whole year of just risking 1% and being break even. And as I got more confident, I think I will start transitioning to 1% on the first trade and then 0.5 on the second trade, but no more than that. So for me, what works is whatever you're doing on a funded stage, you want to bring that over to the live account,
Absolutely.
Like habits and consistency.
Absolutely. 110%. And see, like that's a point I actually forgot to make in this, is that if you're full leveraging on the challenge phase, and then just to say to yourself, okay, now I'm going to be that disciplined trader once I get the account. It doesn't work that way. It's like, if you're going to full leverage to get the account, you should full leverage when you get the account, and either go home, go big or go home. It's like if you're already full leveraging and you're risking this, you've made the decision to be risky before you bought the challenge. And so it can't rely on the fact of you passing or you failing that challenge to be a good trader or to be a risky trader. You've already made the decision to be risky. So in my opinion, the best thing to do is to follow through with that all the way. And now, if you bought the challenge and you said to yourself, like you said, you had the challenge for a year, you were break even for almost a year. You continued, you survived, you passed the challenge, you got the funded account, and now you're continuing to do that same thing. And it's like, that's very wise. And that's how I would go with challenges. It's like, if you want to be risky with them, you understand the risks, that's fine. If you want to have it for a longer period of time and actually make consistent gains with it and not just blow it at a certain point, you're consistent with it and you're consistent with your approach. And so Good point. I appreciate you saying that. Less trades equals less risk. No, this is not true. So less trades does not equal less risk. Each trade is its own individual criteria, right? Each trade is its own individual statistic. And so each given trade that you take has its own statistic. Just because you take less of them doesn't mean that it's going to change the statistics, right? You might get lucky and take a few trades. You might take less trades, and those less trades might all be winners. But I promise you, there will come a point in time where they're all going to be losers too. And so it doesn't perfectly go left and right. Like I said, every trade has its own win rate. Okay, moving down the list. Here, we're an hour 46 in. I gave myself two and a half hours for this, so I think we're gonna be fine. These last few questions are more quick, I believe. And so what trading times do you recommend trading during the day? The reason why I'm asking is because I find I spend too much time on the charts looking for opportunities. I understand high volume periods like pre-London, London Open, close, London close, pre-New York, New York Open, New York close. What times do you trade? Look for opportunities. I would like to set a solid trading schedule for me. Okay, this is really simple. This is Eastern Standard Time, 1 a.m. to 24. So this is 8 a.m. to 12 p.m. Basically what I trade is 7 to 12, 7 to 16. 16 is the latest I'll go. 14 to 16, 2 to 4. I'll trade those hours. 1 to 4 even. Basically I trade all of New York session. I trade the entirety of the New York session. That's what I do. I don't look at the charts ever during Sydney, Tokyo, or London. I don't even look at them at all. I'll look at them from 7 in the morning, or I guess 7 in the morning is still London. That's pre-New York. But I don't consider that London. I consider that the overlap. New York volume is starting. There's already some New York traders up and running at 7. And so you still got London session kicking. And so I would base my trading hours around these two blocks. The overlap is my favorite time during the day. This is when I found the best opportunities every single day. 8 to 11, best opportunities. Sometimes I'll find great opportunities like 1 to 4 in this bubble. I try to take 12 p.m. off. Kind of a, how do you call it? Kind of like a little thing I have that it's a personal preference. It has nothing to do with data. It has nothing to do with it's just my own personal preference. When I used to trade stocks, there would always be zero volume during 12 o'clock because everybody in Wall Street would go out to lunch. And I've heard this from a lot of friends that I have that work on Wall Street, that are traders on Wall Street. And they always told me, lunchtime is real. It's like the lunch trading hours are real because everybody's out to lunch, nobody's trading, and the volume dies down a little bit. But yet again, I wouldn't take that all the way to heart. It's just a personal. I eat lunch at 12 too, so that's a personal preference type of thing. But I would base all of my trading hours around London and New York. The overlap is one of the best times to trade, and the first half of New York session. I think that these 4 hours, the 8 to 11, are the best hours of the day, in my personal opinion, for what we do. You have news very typically at 10 or at 8:30 a.m. Very, very, very often. 8:30 a.m. or 10 a.m. And USD news most of the time. And this kind of goes into the pairs that you trade too. If you're trading JPY London pairs, or JPY GBP pairs, London pairs, maybe you'd be more inclined to trade London. I trade all USD pairs, GU, gold, and NOS. NOS happens from the stock market open at 9:30 until the close at 4. So the main trading hours I have for NOS is pre-New York Stock Exchange open and then post-New York Stock Exchange open. Gold loves moving all throughout the day. Gold loves moving Tokyo, Sydney, London, New York. Doesn't even matter. It just has a mind of its own. And so sometimes I'll get great moves right when I wake up at 7. Sometimes they'll happen at 8. Sometimes they won't happen at all. GU, same thing as gold. A little bit less during Sydney and Tokyo than gold, for sure. But it moves good during London. I think it moves even better during New York. So I would break your sessions into 2. And that's kind of what I do. I have my morning session and I have my afternoon session. You know, if I ever come back to trading full time, which I think I will in the near future, maybe a year or 2 from now, once I have a big enough account where it just doesn't make sense to do anything else anymore. I'm not there just yet. Right. And so the way I'm going to break up my session is the first half and the second half. I'm going to have the morning, a nice long break, afternoon. And that'll just be the New York session. That's what I like. That's what, what works for me. If you live in London and you have the first half of London to trade and then the overlap, I think that's another great 2-session break. If you want to do 1 session, I think 1 session is perfect. And you could just trade this overlap or this after. I wouldn't trade just the afternoon of New York. It's a hit or a miss. One day it'll be good. One day it won't. But that's how I base this. It's a very simple question to answer. You just base it off London, New York, and I don't think there's much more explanation to go into that. Don't overcomplicate it. Put your life first before the trading hours. Whatever works in your life is most important first. Secondly, whatever works trading hours wise. And that's how you set it up. So think about your life first more than always your life. You come first. Second is trading. How are you going to fit that in here? Yeah, and you could do kind of what I did here. This is my sleeping time, made it black. This is my trading time, I made it pink. This is my lunch hour, I made it red. This is the last half of New York, I made it orange. So pink, orange, I trade. X, I don't. Black, I'm sleeping. Easy, done. Don't overcomplicate it. Yeah, I hear a question. Go ahead. Does someone have a question?
You can hear me, Mike?
Yeah, I can hear you.
Sorry, I don't mean to add on to everything you're saying, but this one just felt really close to me because I had a time in my journey when I was trading where this was like a very annoying question, like what time should I trade? And what worked for me, I broke it down into 2 sections, which were just like the facts, which kind of like what you pointed out with the high volume periods, and then your personality. Like I know I personally, I don't like to trade too long, like for me 2-3 hours. I like to just be very, very focused, so I know 1 session was going to be good for me. And then during the times that I'm studying or working, like just your personality and just the facts. You want to be trading at a time that has high volume, and then your personality, and then just I think that's what made it easier for me. And I just knew, all right, because I wanted to trade London, but I just couldn't, bro. I could not wake up at 2-3 o'clock, and I would force myself.
Yeah.
And for me, my personality was just New York just fit better. So.
Yeah, but I think the beautiful part in that too is that you tried trading London, right? And that's the key there is try. And to answer this question even further is try. Try all the things. And you've tried London, so now it's not that you feel like trading London wouldn't work for you because no, I know I don't feel anymore. I know trading London doesn't work for me because I don't like waking up at 3. I know I don't like doing that. You know it. It's a fact. You don't have to think about it. And so now, even if you see a trade happen at 3 a.m., even if you see a trade happen at 4 a.m., and it's the most sexy, beautiful trade ever in the world, I would have never fucking been up at that time. I would have never been there at that time. It doesn't matter to me. You don't get that emotional like, oh man, I didn't wake up at 3 a.m. today like I should have because I'm missing these opportunities in London. No, you say it to yourself like it's a fact. You say it to yourself like, I don't fucking do that shit because I'm not a junkie. I'm not going to wake up at 3 a.m. and be up when all the owls are up outside. No, I get a good night's of rest. I wake up, I make my delicious cup of coffee. I have my fucking croissant. I get to the charts at 8 a.m. and I'm New York, London overlap. That's who I am. You identify yourself and you really, really master yourself and who you are. And so good point. I love that. It's great. That's great. Very good. Yeah, and I think that's it for this question. I mean, like you said, it's not a very complicated question. It's just finding what works and basing that around high periods of time. Hey, Mike Toko, do you see this pattern repeating? Break out, break back in. Is this a pattern is this pattern, the reason you took the trade. So yeah, this is the trade you were referring to. And to break it down in the simplest form, I don't even, yes, it was a breakout, break back in. I tried looking for more examples of this actually, and it was very hard for me to find good examples. As I get older, as I've been trading the strategy more, my lens in the markets and the way that I look at them is starting to change. I used to look at everything through like double tops and double bottoms and breakout, break back ins. And it's like now I'm starting to like look at the markets more as like turning points and like where is this turning point happening? And it's like to me, like I drew this earlier. This was a turning point here. This was a turning point up here, and then this was a turning point down here. If you still understand the markets in the way of this, yeah, you could say this was a breakout, break back in, right? This is your low right here, if you want to consider this a low, which I think you could. And then, we had a break of that low and then an immediate break back in. It wasn't immediate. I guess you got that break, a little bit more of a break, and then broke back in. So this one's not ideal. And usually when you see breakout, break back ins, it's like a strong candle close to the downside, break under, and then a strong candle close to the upside, break back in. And so this one's definitely not pretty, but I literally couldn't find one. All these levels are being respected so perfectly. Like this one, if this broke up and then broke down. And I really like breakout, break back ins in counter trend situations, which give me a lot of confidence for counter trend, because essentially what a breakout, break back in tells me, and the reason that I like them so much is because it tells me that the level where price respected, I'm writing, but it's not going to pop up on the screen for a second. I don't know why it's been doing this. So you just give it a second. Level when price respected, but failed miserably. And what I mean by that is that this is, like I said, not a good example, but when price really is like, no, we're going to go down. We're going to keep going down. And then it really tries to make that break. But that buying pressure is just so freaking strong, where they were like, we know you want to, the bulls are like, to the bears, the bulls are talking to the bears. They're like, we know you want to break this. We know you want to keep going, but there's absolutely no way in hell we're going to let that happen. We're going to push you back up. And so that pattern is so powerful because it tells you, it's like, hey, whatever is down here wants to push price up really bad. And so if you're going to continue taking those buys up, you're on the strong side. You're on the side with these people down here that are like, we're pushing price up no matter what. And you want to be on their side. You want to be friends with them. These are cool guys, cool people. Like that's where you want to be. That's the big money, whatever you want to talk about, liquidity pools, order blocks, whatever. But the breakout, break back in is a great pattern. And to put it simply, I think you can use any patterns. You could use the pause and goes that I talked about before, right? Where's the pause and go that I talked about before? You can use the downtrend double tops, right? Those are this is actually my favorite pattern in the whole world. I fucking love double tops. I used to only trade double tops back in the day. But I just don't look at the markets this way anymore. And so I don't have a need for it, and it's fine. Uptrend double bottoms. That was a really disgusting one. This is all basic stuff. And then you have the break and retest, right? A break happens here, the retest happens here, and price continues to go up. And so these are all simple patterns, but notice how one thing that I have to do in every single one of these pictures that I drew, every single one of the pictures, I'm drawing a key level. I'm drawing a key level. I'm drawing a key level. Forget about what the price is looking like. Or I guess in this one I forgot, but it would look like that. I'm drawing a key level. Notice how in every single one of these examples, I'm drawing a key level. So this is all based around key levels. This is all based around price respecting, price failing, price continuing, price pushing, whatever. But whatever patterns you want to use, if you limit yourself to these four, I feel like, if you interpret something wrong on the charts, you might miss a pattern. You might miss something. And so instead of doing that, what I would say is just focus on the key levels. Focus on the key levels. Focus on good, solid trades. And so, yes.
Love you, Mike. Thank you, bro. Amazing.
Of course.
Wow.
And yeah, this is the 1 minute structure, but we already went over this so in depth earlier with the whole break even part, right? I'll just drive that home a little bit more, right? Inflection points. I made a new word for it, so I hope you guys don't mind. Inflection points, right? And so what I'm looking for is we have the high created. As soon as the high is broken, this is where our stop loss goes. New high created. As soon as the high is broken, new stop loss point. And so you have to, the problem with this, and it's kind of ass backwards, because your first thought when you get this push, let me clear this up a little bit. Your first thought when you get this push is, let me move my stop loss up somewhere, right? But the problem is that you have to wait with patience and weather the storm. And what I mean by weather the storm is this part right here. You don't know if that's going to come back down further. It might come back down there. I mean, at this point, granted, your stop loss is already here. So that's the lowest point that you would get stopped out at. But let's just say that your stop loss was still here. You have to weather this storm all the way as low as it wants to go. And until that break happens, then you can move your stop loss up. And so that storm can be as simple as something small like this. Then it breaks. Now you can move your stops. Beautiful. Happens again. You have a high, low, low, break. Move your stops. Super simple. Just basically price action trading. And this is a perfect example to use. I mean, it's just beautiful 1 minute structure. And this is what you want to be looking for. I mean, guys, like, this is what trading isn't about being perfect, but sure as hell trying to do it. Trying to get to that point where, like, you're just being a robot, you're executing. And it's like, nothing will be perfect in the markets because the markets are imperfect, but you try to find perfection with it, and you try to find something that you like within it. And so that's a basic example and just a thought process on the whole patterns and breakout, break back in. It goes along with all the patterns and with everything. How to get really good at reading and avoiding terrible 1 minute structure. And so that's a very, very interesting topic. And I love this one. I love this question. This is probably one of my favorite things to do when it comes to this strategy is reading 1 minute structure. And it's like, it becomes so tedious and fun and not fun at the same time. Actually, let's just do this. I don't want to clear my charts, so I'm going to study these later today. Oh, wait, that's the one I use. Oops. Let's go here. Okay. Perfect. Okay. So, reading 1 minute structure. And so, let's just start here. We're going to read the 15-minute structure first because you always have to do that, right? So, you have the 15-minute structure going up, and we're just going to mark this up the same way. We go down, we create a low. We're thinking that we might continue going up. These buys would have probably been pretty fine to take, to be completely honest with you. And so you may have gotten stopped out on these. If you took those, it's fine. 11 a.m. Tuesday, yeah. Could have taken that. Whatever, doesn't matter. Breaks the low. As soon as it breaks the low of that candle, it completely invalidates that whole like push up idea. Now the idea is push down, right? And so makes a low. Now, once this is formed, now we're starting to see, oh, this was a high that was interesting that we should have marked off. And we could even bring it over a little further left here. There we go. Okay. And so the main areas that we want to focus on when reading 1 minute structure will be here, here, and here. And then also here, here, and here. Right? And the reason why I say here, here, and here, I mean, I think I've driven this point home so many times today, right? We have these inflection points. The chart is changing directions around these points, right? These points are super important. This is where that change happens. It comes down, it changes down, it changes up, it changes down, it changes up, it changes down. And so these are the important points. Now, what I want you guys to understand is that when we read 1 minute structure, when we read any structure on any chart, on anything, what we're doing is we're basically using a magnifying glass and magnifying into this point right here. This circle is representing the magnifying glass. When I click on the 1 minute, you're going to see this point, but you're going to see it zoomed in. You're going to see this point, you're going to see it zoomed in. And so if I was to ask you guys a question, when I zoom into this, what is this going to look like? Right? And I don't, it's a rhetorical question. I don't want an answer right now, but I'll tell you. First, you're going to have a 1 minute downtrend from this candle. Then this bullish candle happens. You might have some kind of bullish structure starting to form. Then you have this bearish candle. And so then it broke the low, made a high, probably push phase. And so this whole entire thing, let's go on the 1 minute. Let's see. Okay, so this is what we're saying. Downtrend, right? We had a reaction up, and then we continue going down. So let's see. Wow, isn't that so strange? You have a downtrend, structure starting to form up, and then a breakdown. What the fuck did I literally just draw? Excuse my language. Downtrend, some kind of structure to the upside, breakdown. Downtrend, some kind of structure to the upside, breakdown. Guys, it's so simple. There's nothing to overcomplicate more than that. All you're doing is I can predict what the 1 minute structure is going to look like off the 15 minute already. Just based on the candle closes, like a bullish candle will more than likely indicate that there's an uptrend on the 1 minute. A big bearish candle like this will more than likely indicate a downtrend on the 1 minute. A huge bearish candle like this will probably mean, okay, there was either some kind of news or like one 1 minute candle was just gigantic and closed huge, or a couple of them closed huge. And it's like these kind of candles I don't love trading or whatever. Not the point I'm trying to make here, but it's like off of this, you have a bullish candle, bearish candle, right? And so that's structured. Now we come down here. Now, once we've created this bearish and this bullish candle, this is the next opportunity that we were looking at, right? We took this opportunity, we lost, and we weren't wrong about it because the 1 minute structure was actually starting to go bullish. And as this candle started to open, that wick probably would have triggered us in. And when it triggered us in, it would have went back down and stopped us out, whatever. Now the next opportunity is this bullish candle. And so 1145, we're going to come down. Whoopsie. I'm buying the new professional version of TradingView, and I haven't purchased it yet because my subscription just ended from my annual of last year, so it's funny. Okay, so next trade, 1145. 1145 is going to be right here. Right, let me take this box away. And so this candle here closed bearish down. Now this candle here closed bullish up. All we're trying to validate is, does this structure resemble an uptrend? To me, it's a little bit of a tough decision, right? We have a down, up, down, up, down, up, down, right? And so as of right now, I really want to see price come above these highs before I take a trade. And so this structure, even though it is resembling an uptrend, until this happens right here and fully breaks above, do I get interested in this trade? And so that might have been a little bit too late. Actually, no, 1245 happened here. Candle opened. Next candle is 12. 12, 11. So that candle closed below the highs. The next candle opened and started pushing up. more than likely I probably wouldn't have entered this trade. And so I'm being a little picky here, but I want you guys to see something. 11:59. This is the candle close of the next candle. So I'll make this a little bit bigger. I'll make this a little bit bigger. Here we go. Basically what I'm looking for is if this candle here closed bearish, right? And this candle here closed bullish, I want this next candle to continue that bullish sentiment to the upside. And and this all comes from the knowledge that we already have that this is a 15-minute key level. We've created a bearish bullish reaction. We've gotten some kind of rejection that we liked at this inflection point, and we think that price is going to continue going up. So all that's already set and done on the 15-minute. Now all we're trying to do is interpret the 1 minute so that we can get a good, decent entry and stop loss. And so at this moment in time, 11:59, this candle closes. The only entry that I can look for would be the break of this high, which I don't love. And the only stop loss placement that I'm really confident in, I mean, I'm not sure I would use that. I would be much more confident underneath here, or even underneath just this whole structure. And so if I was just to put it like that, I've done that a couple of times. If we enter here and put it underneath the whole structure, we're looking at a 120 pip stop. On GU, I'm not taking that trade on the 1 minute. Sorry. We put it under here. It's a 9 pip stop. Not taking that trade. Under here, 5.5 pips. I could maybe get behind that, but the way that the structure is working and the way that this is looking, I mean, I really can't even, I don't even know if I can explain this very well, but this is like almost like a feel type of thing for me. I don't have a clear high to break. Like in current price action, I don't have a clear high to break. Once price comes down a little bit and starts going back up again, and this break happens, I can start considering this. But yet again, we're dealing with 10 pip stop. That's a huge stop. My range is 1-to-1 basically. I would much rather get a much better range, 3R. That'd be way better. But we don't get that. And also, this structure is a little confusing. Even though we are making these steps up, we are starting to show an uptrend. This is the high that has created the low. It's not broken until the next candle opens. I would want to see this candle right here break this high. And I hope this is making a little bit of sense. I would like to see this candle after so we have the bearish candle here. We have the bullish candle that's next. If this bullish candle gave me structure like this and it closed at the same exact point, and this is how it happened, and we've broken above this point and we've cleared this level and everything's good, I'm 100% all for the trade. But if that change in structure hasn't happened, just yet, and we're still trading below this level, then I start getting a little wary. Because I know that one of two things is going to happen here. Price is either going to come back, respect it, and continue going down, or come back and break it. And so there's a 50-50 chance that what I want happens or what I don't want to happen happens. And so you're in a much better situation if you wait for that break to happen first, and then you get that retracement. And then you could enter at the break of the high, and then you also want that clean high. But like I said before, the main we'll get the same examples here. How do you read this 1 minute structure? Well, we know this key level from the 15-minute. This is all done from the 15-minute. Now we're just using our magnifying glass again. Like I had these circles drawn, right? This is our inflection point that we're changing, and so we're just looking for a change in this structure at this key level. And so how do we get that change? Well, we're coming up. We come down, we go up higher, we come down. Okay, this is interesting. This rejection and this break, this is our first sign, right? We didn't come back up to retest this. We broke the lows that have created the current highs. This is a significant change. Now this is our next I just went over this example too a little bit ago. This is our next change, right? Once we break past these lows and continue lower, now we're just trending to the downside, right? And so here we're in an uptrend. This whole entire area here is explained to us that we're uptrend, and then we start going up. We fail. We break. We're failing to make new highs, and we're continuing to break the lows, making lower lows, lower highs, downtrend. Simple. This is how I look at the 1 minute. I mean, and I'm trying to be a little bit more liberal with this one versus the 15 minute. 15 minute, you could zoom in a lot further. You could look for. I would never do this on the 1 minute, but you could look for like this level, right? This is how I'd be looking at the 15 minute. And notice how I'm looking at the 1 minute is a little bit further out. But the reason for that is the whole magnifying glass part. See, like, look how big these circles are. I want to be able to see the whole circle because that circle on the 15 minute is exactly what we were just talking about. It's those inflection points. It's those points where price is changing, price is doing things. And so I want to be able to see that full circle. And so being able to see that full circle means zooming out a little bit, and that's okay. And so, I don't know, Sam, you could elaborate on this a little bit if you want, to let me know if you have anything specific that you wanted to know about the 1 minute structure. But essentially, it's just the stop loss placement and entry for me, and that's the most important. And so, I'll let you say something if you have any questions.
I think you drove it home, and it even ties back to the way that I said that I wanted to view the market as far as on a higher time frame, just trading key levels and just focusing on that. I love how you explain this because it's like it's something that I already knew, but it's like just you saying it is just driving it home. Once I get that key level confirmation and I get to that major turning point, then obviously for that good 1 minute structure is waiting for that structure to align, which in this case, if we're looking for a reversal from the bottom, that break of structure where you mark that high, I need to see that break before going. So then I guess just that part of just keying in into details on the 1 minute time frame is the best way I can say it after I get my confirmation from a key level higher time frame. So that was perfectly explained. Thank you, bro.
Cool. Great. Yeah, and that's the most important part. You want to see that change in character, change of structure, change of whatever during this candle before you enter the next candle. And it's like you don't necessarily want to expect that it's going to happen in your next candle. It might, but it might also do something like this where it reacted from this level, came all the way down, and then went back up. So I don't know. Important to definitely fine tune into the details with the 1 minute structure, and so yeah, so that's 1 minute structure. And so we got, I think, 3 more questions. We're almost done here. This has been a long session. I'm glad for those of you guys that are still in here, and thank you guys for being here. This is all going to be uploaded and posted. And I see you guys have actually asked some questions in the chat, which I will get to at the end of this. So hold on. And so avoiding good/terrible 1 minute structure. Basically, what terrible 1 minute structure and good 1 minute structure for me is. Good 1 minute structure is like a kid that listens to you and you tell him what to do and he does it. Bad 1 minute structure is a kid that you talk to and he does his own fucking thing and he doesn't listen to you at all. And it's like, you want to see those breaks of those highs. You want to see sustainability. You want to see the breaks of the lows when you want to see them. If it does what you want it to do, that's good structure. And make it very generalized. Bad structure, you're seeing it. You're trying to make up stories. You're trying to make it good. Most likely bad 1 minute structure. And no matter how good the 15 minute setup is, actually, in most cases, if the 15 minute setup is very, very good, the 1 minute can dictate whether you enter or you don't, if the 1 minute structure is really that bad. If the 15 minute close is meh, but the 1 minute structure is beautifully amazing, that could dictate whether you enter the trade or you don't. And so the 15 minute and also the 1 minute can both dictate whether you're going to enter the trade or whether you're not. And both of them have to be good enough for you to do it. So it can't just be the 1 minute time frame and nothing on the 15 minute. And it can't just be the 15-minute time frame and nothing on the 1 minute. Both of them have to work in unison, and both of them have to be decent. One sometimes will be better than the other. The other will sometimes be better than the other one. And so it's all up in the air, and it's never perfect, but you need both to be okay. At least okay. You can't ever rely solely on one. And that's what I found for my own personal trading. The way I trade, the way I do things, I need both to be decent. I've tried getting rid of the 1 minute time frame and just trading on the higher time frame candles. Something doesn't fall in line for me. And so both need to be okay. And so, yeah. I'm not sure if you've mentioned this before, but what are your trading pairs and why do you only stick with them? Also, for those who missed the session, will you consider uploading it? I will be uploading it, brother. So you are in luck there. I think you're in the session. I saw you, I believe. No, you're not. Okay. I will be uploading it. So don't worry about it. And the trading pairs. Trading pairs I use is simple, man. I use GBP/USD. And this is going to pop up on the screen in a second here too, because my pad has to update. XAU USD, which is gold, and then NAS 100. And now I will go into depth on all of these. These are three different sectors. You have New York Stock Exchange tech, which is one. You have commodities, which is two. And then you have currencies, which is three. And the reason that I've picked three of these specifically, gold, GU, and NAS, is because this is one of the highest volume currency pairs. This is one of the highest volume commodity pairs. And this is one of the highest volume New York Stock Exchange indices. Besides SPY 500, SPY 500, right? Whatever. And then DJ 30, which is Dow Jones 30. And then you also have QQQ. You have IWM. There's a shitload of them. And they all, honestly, I've just had the best luck with NAS. I like NAS the best. There's no rhyme or reason to it. US 30, you could trade SPY 500, SPY. That'll be fine. And so it doesn't matter. SPX 500, that's what I was looking for. Holy shit. It doesn't matter. But the main part here is that these are high volume, high volatility, and different sectors, right? I'm not trading GU, GJ, and UJ. And those are my three pairs. Why? Because more than likely, if the yen and Great British Pound, let's just say the yen and Great British Pound aren't really doing much for a month. This is not going to be doing much. This is not going to be doing much. This is not going to be doing much. Unless that dollar really kicks in that volume. And so then I'm solely relying on the dollar volume to do something. And if it doesn't, then I'm not going to have any luck. And so if GBP or USD are slow for a month or for two, whatever, but the stock market is booming, I'm good. World War III breaks out. Everyone's putting their money into gold. Commodities are going crazy. US dollar is going down. New York Stock Exchange is going down. All these pairs have different sectors, and they ensure that my trading quality will stay at a acceptable level at all times. During the summers, currencies usually fall a little short. This summer, NOS was fucking great to me. Gold was great to me. This summer has been fantastic so far. I have no complaints. The school year comes around, maybe these two will slow down and GU will start picking back up again. I don't know. And so the reason that I pick these pairs is, number one, volume. Number two, the word I'm looking for is diversity. You want to diversify your pair. You don't want to do GU, GU, GU. If you want to do it that way, I would recommend just sticking to the one and just picking GU and calling it a day and not having the other. This way, the way that I'm doing it, it diversifies my pairs into 3 different sectors which do 3 different things. It's like, yeah, most of the time when GU is going up and gold will be going up and NOS will be going down. I've seen that confluence many times. But that sometimes NOS will also be going up with it, and sometimes GU and XU will be opposite. Doesn't matter. But the main part here is the volume and the diversity, and not trading too many of them. I like the 3 pairs, and I've explained this before. I like the 3 pairs because if 2 and 3 aren't good, then maybe 1 will be. And I usually only focus on one of them a day. And right when I wake up at the charts, I'll look at structure. And if structure looks terrible on gold, I cross it out for the day. If structure looks terrible on NOS, I cross it out for the day. If structure looks beautiful on GU, I check it off, and that's the only one that I look at for the day. And I make my job easy. And so I'm not actively trading 3 pairs and looking at all of them religiously. I usually pick one of them per day. And sometimes this will get better and I'll miss a trade and I'll miss a trade here. But I'm focusing on this for the day because that's where I want my focus. And so that's why I stick with them, and that's why I use those pairs. Session will be uploaded. Do you only trade 2 CT 15-minute with 1-minute structure, or do you trade other concepts as well? According to your current stats, what are your hit rate? What's your best risk to reward? Okay, so yes, right now I wouldn't even call this 2 CT, right? Because 2 CT is like last candle bullish, next candle bullish. And the way that I do this is more so 15-minute structure with 1-minute entries. That's really what I'm doing here. Is I read the 15-minute structure and I predict where the 1 minute's going to go next. The 15-minute structure tells me where the 1 minute's going to go. A bearish close on the 15-minute with a wick rejection to the upside more than likely means that 1 minute is in a downtrend. That is very nice and waiting for us to sell and put our stop loss above to take a 1 to 3. That's all that we're doing here. You know, it's the 15-minute structure, 1 minute entries. And so what concepts do I trade? Well, I have this belief, and this belief stems from fractals. And by fractals, it's you have 1 that goes into 4, that goes into 8, that goes into 12, that goes into 16 or whatever, right? And so what I mean by this is if these were hourly candles, hour, what you see on the 16-hour time frame, I'm just using crazy examples here, will theoretically be very similar to the 12. But now going back to the example we had, all it is you have 1 candle on the 16. On the 4, it's just going to look like this. Right? That's what it's going to look like on the 4 hour. So this is our 4 hour. And this is our 16H candle. And so now with all this information that we're seeing here, we're just seeing it zoomed in further here. It's still the same thing. Price went from this point down to this point. Nothing's changed about that. Price went from this point down to this point. And so the point that I'm trying to make here, and I hope you guys can see this. I don't know if you guys can. Here we go. So the point that I'm trying to make here is essentially saying we have time frames, and these time frames represent candles. it doesn't change the fact that price moves up or down. And so if you're looking on the 15-minute time frame and you have a candle close bullish and structures to the upside, and that's our inflection point that we were just talking about, and everything's perfect and everything's the way that we want it to, then we could take that next candle assuming that it's going to be bullish. Now let's just erase 15 and let's write the same thing with 1H. What changed? Now let's make it 4H. What changed? Now let's make it 30-minute. What changed? Nothing. Right. I'll tell you one thing that did change is now when we draw that circle, right, that zoom in point, that inflection point, and we're going to zoom into it. If we zoom in from the 4H to the 1 minute, there's going to be a big jumble of mess here because this is a lot of information. If we go to the 5 minute from the 4H, it's going to look cleaner and you're going to start seeing this portrayed much better, much easier. And so the one thing that you do have to keep in mind, the time frames don't matter. The concept stays the same. I trade on all time frames. I have my favorites that I just look at, right? I use the 15-minute, the 2-hour, the 30-minute, and the 1H, and mostly the 15-minute. But I've seen more patterns as I've done this for a longer period of time, and so I'm starting to use other candles as well. But basically saying you have the 4H is fine to use. You want to keep your entry time frame close to your structural time frame. Because if you use too big of a gap, you're not going to be able to read the structure as well. It's going to be too much information. You're going to zoom in too far. You're going to be zooming into this like small little wick right here. And then you don't want to see just that wick. You want to see this circle, right? You want to see these two candles and how those candles have been forming and what's going on. So the gap between the time frames has to be specific. And a gap that I like using is 15-minute, 1 minute, 30-minute, 2-minute, 1H, 3-minute, 2H, 3-minute, 4H, 5-minute. Right. And even going down to your 4 or 3-minute on 4H, I think is fine. I think that's okay. Using your 2-minute on 1H is fine. Using 2-minute on 2H, getting close, but okay. Using 1 minute on 30-minute is fine. Right? These are the small little things that you have to hash out for yourself and see what works for you. Sometimes I will use the 1 hour 3 minutes. Sometimes I'll use 1 hour 2 minute, and I'll change it up. And it's like that's just from me and seeing the charts and reading what's going on in current price action and seeing which one I like better. And it's like I actually like my stop loss placement on the 2 minute better, and there's a much more clear high on this one, and this makes sense with the 1H time frame. And it's like I could take this. So it all depends. But I would just keep your entry time frame and your structural time frame close. And so I do trade other concepts, and I hope that explained essentially that. And according to your current stats, what's your hit rate, your best risk to reward? I don't love talking about this. I don't think it's very important to you guys. It doesn't really change your stats. It's not going to change your trading at all. But currently I sit at around 40% win rate, with a 1 to 2.7 average RR. Best trade, probably like 6 to 8R. Yeah, nothing too crazy. This is my account flip from 7K to now over 100K. And that's what I did it with. You can call me crazy, but it is. It truly, truly is. And so you don't need to change the world here to make money. You just need to be consistent. You need to trade well, be consistent, do the right things over and over again, and you're going to be fine. And so, don't necessarily listen to my advice there. Okay, we went over this. Last two questions, and then we're out of here. I'll take the last couple of questions in Discord after. Is trading one session a day a good idea for now when I'm not profitable, or can trading 2 sessions give me more opportunities and will help? I think so. I think the whole entire spiel I gave earlier about trading hours and trading time and everything, that is the most important. So you have to have life over trading. More does not equal more in trading. And I'm going to explain. The more you do in trading, the less you're going to make. Less equals more. Now, obviously, if I could sit down and trade all day long and look for every single opportunity, would I end up making more money? Theoretically speaking, yeah, I'm at the charts for a longer period of time. I'd be able to make more money, right? I'd be able to do more stuff. Okay, fine, whatever. I agree. But there's a flaw in this, because it's just like with anybody. It's like, I had this very interesting thought the other day where certain companies don't give you a paid lunch, right? You have an unpaid lunch. And so you work for 8 hours in the day, you have an unpaid lunch for 1 hour, and your total workday is 9 hours, correct? Now, would there be an issue in working for 8 hours straight, not taking the break, and just taking the lunch break at the hour at the end of the day, and you just leave an hour early? Now, some places, some jobs tell you that you can't do that. Some tell you that you can do that. Some people want you to have the break in the middle of the day. Some people want you to stop for a second, get some food, come back and keep working because they think you're going to be more productive. And so it's the long-winded example there, but to come back into trading terms, the more you're going to do, the longer you do it for, doesn't necessarily mean that you're going to make more. Because it's like, without that lunch break in the middle of the day, it's like, yeah, you're still working for the 8 hours, but it's like by hour 6 or 7, you haven't had a single break. You're just sitting there staring at that fucking computer like a zombie. And you're like, oh, like, can I even make it? And it's like that hour break rejuvenates you, gives you a second to relax. You eat some food, you get some nutrition into your system, you get moving again, and you actually benefit more from it, from taking that break, from taking that relaxation. And so I think that I would look at your life, see what you're doing, and make trading fit into that. Trading more will not make you more profitable. It'll not make you profitable faster. What will make you profitable is identifying yourself as a profitable trader. Starting to look at your numbers and see if you are profitable or if you're not profitable. It's like the whole profitable thing is, it's such a scam. Because like people think that they're going to reach profitability and that's going to solve all of their problems. It's like, more than likely you're pretty fucking close to profitability. Or not, you're a break-even trader, or you're, with all the information that you have and all the knowledge that you have, and I'm saying this specifically to you, Ajmal, is like, with everything that I've shown you guys, I've done for you guys, you've applied, you've done everything with it, you're more than likely very, very close, if not already a profitable trader. And if you're not, you're more than likely a break-even trader or a very, very small losing trader. Maybe 1% over a long period of trade. And so what I mean by that is that you have to start setting different goals for yourself. Not to reach profitability, but maybe to make money. Now, how are you going to make money? Well, you're going to get a funded challenge. And what's the max amount you can risk on that funded challenge? Going way back to what I said earlier about rules versus intuition. What's your rule on your risk? And why do you have that rule? Is it 0.5 or is it 1%? And why are you using that risk? And now what is your goal? Is your goal to get a payout? Is your goal just to follow your rules? Follow your system, you know? And so no, I wouldn't trade more. Put your life before trading. Don't worry about it. Don't overextend yourself. You know, me and Sam have done that both with trying to trade London in the past, and it's not worth it. I'll tell you that from experience. And I think this is the last question. And so I'll wrap this up and then go over the last few Discord questions, and then we're out of here. I remember you lined up your trading timeframes and had 15-minute 2H through 30-minute 1H. Why is 2H your second best rather than 30-minute 1H, or closer to your 15-minute? You have observed or how we trade that make a 2H a favorite? What have you observed? What have you observed from how we trade that makes the 2H a favorite after all your time favorite? Okay, I think personally, and this is going to sound interesting, I did some thinking about this when I read this question this morning. And I think the difference between 2H and 1H is the time of close, right? The 2H on my GU and XU, and then also NAS. NAS closes 8 a.m. and 10 a.m. Pre-New York Stock Exchange, and then post-New York Stock Exchange. These are like perfect times to be entering into the markets to expect further volatility later. So I'll have a nice candle close from 6 to 8 a.m. That's bullish, let's say 6 to 8 a.m. And I want to be in the candle from 8 to 10 a.m. And I know that that candle will be during 9:30 a.m. 9:30 a.m. is your New York Stock Exchange open. And so the fact that I know that it's going to be during New York Stock Exchange open, I know there's going to be a high amount of volume. 10 to 11, there's sometimes news at like 2 p.m., 12 p.m. on NAS, and I like the 10 a.m. candle too. That's just a preference. I don't know why, but also, you know, to go back to this is just kind of like one of those like rules or intuition-based things. My results on the 1H have always been a little skewed. They've never been fantastic, and I've never liked trading the 1H. I just thoroughly do not enjoy trading the 1H time frame. I don't like the hourly candle closes. You know, 8 a.m., 9 a.m., 10 a.m. There's just such strange times to me to be like constantly looking at the markets at those times. It's like to me, I want to be trading the 1 hour candles while they're happening. And I don't know if this is going to make sense, but like 8 to 9 a.m., that's a time block for me. It starts at 8, it ends at 9. And I trade between 8 and 9. And so 8 and 9, I have 4 15-minute candle closes. And so the candle close from 8 to 8:15 will tell me where the next 3 might potentially go till 9. Whereas like the 1H, it's just, this is just a feel thing, you know? It has nothing to do. Like data wise, 15-minute is my best. 2H is my second best. 30M and 1H, I don't have too much data on. But 15-minute by far best. 2H second best. And the only reason why I say 2H second best is because it's better than 4H. 2H is better than 4H. I've had better results with 2H than I have with 4H. And so 30-minute and 1H, I have not traded enough. I have not back tested enough. I have not forward tested enough to have good amount of data. And maybe that's the reason why I don't like them. The 2H works very well when I don't have a lot of time. $15M works great in general. When I do have time, I can sit down, I can trade the 15-minute. It's awesome. It's my favorite one to trade. It's super fast-paced. It's super quick. I love the 15-minute. And so this is all just from intuition, a little bit of data, a little bit of everything. The time that the candle closes, you know, GU and XU close at 7 a.m. and 9 a.m. instead of 8 and 10 like NAS, I believe, which is very interesting because you'll have news for GU and XU typically at 8:30 and at 10 a.m. And so I'm entering before the first news, I'm entering before the second news, or after the first. And so they're well placed candle closes. They're not like 5 minutes before the news. They're typically like 30 minutes before, 30 minutes after, an hour and a half before. And so you get a good amount of price action, and then you could already be like very comfortably break even in your trade by the time that the news does come out. And it either just sends it to the moon and then you get to make an additional 5R for the day for no fucking reason, or you just go break even and it is what it is. And it's not a big deal. And so that's why I like those trading times and those pairs. It's just my that's my favorite. Go ahead,
It's
Sam.
so methodically thought out, bro. Wow, I appreciate that. Makes so much sense. Like when I asked this question, I was like, oh man, like this is about to be a really nice bonus question to ask. And the way you broke it down was so methodically, bro. Like your process and the way you view the markets and your system, your plan is just it makes sense why your account is where it's at from, you know, where you started.
No, absolutely, bro. You know, it's like these small things they make a big difference, though. It's like, you know, if you enter the news trades an hour and a half before, it's typical you're gonna have a lot more room to work with that trade at that point. It's like you're just gonna have a lot more room, and that room is gonna be the difference between you losing the trade or you making 15R on it. And so I'm glad that made sense. That's awesome. That's good to know. And yeah, and I wouldn't shy away from any of these. And even like, I don't know, you see 3H and you're like, the 3H, you know, I've never even tried it. Like, I don't know, maybe there's like a 20-minute candles. I don't know if that could even work, or if that would, maybe it's going to be better. Like you have a candle close at like 8:20 and then 8:40 and like 9, like that would be so strange. And so like, you know, this is the whole beautiful part of this, is that it's a system process, thought process, whatever you want to call it, that you use. And then after that, you have and then you have free reign. So, you know, the whole, that goes back to the whole rules and intuition thing, is like you use your rules, and I'm doing air quotations right now, your rules, to, you make them based off of what your intuition is. And so you try the 20-minute, and then you're like, okay, works. I'm starting to see this. I'm starting to see that. Then you go back to the 15-minute, and you're like, that wasn't good. Then you try the 30-minute, and you're like, oh, this is interesting. And then at a certain point in time, you're going to start gaining this kind of information. Where like, I can tell you guys this stuff, but Sam, you're close enough to me in where you live, in the time zone that you are, and everything, where this applies to you a lot further. But it's like, I'm catering this to everybody, where somebody can be in London, there could be news at 3 a.m. The 2H candle closes at 3 a.m., so that doesn't work for them. So then they have to use a different, you know what I mean? Like this all, it's a thought process, and everybody's going to have their own way of doing it. Everyone's going to have their own pairs, their own trading times, their own everything, and everyone's got to figure it out a little differently. And so yeah, I'm glad that made sense. And let's see these last couple of things here. So when we're not profitable, it would be good to focus only on A plus setups first. Yeah. I mean, bro, I don't think he's in here anymore right now, but I think every single trade that you take should be A plus setup and nothing else. I think every single trade, like every trade that you look at, you should be like, this is a great trade. I should probably take this. You should never feel like, oh, I feel so, you know, what if this keeps going? I should probably enter this. Like, what if you have like that FOMO build up? No. Every trade that you take should be a plus setup. It doesn't have to be perfect. I don't want to stretch the importance of perfection, because you'll never find it. And trust me on that one. But focus on those A plus setups for sure. Power of compounding the account, so important, bro. You start small, and then your mind will be blown a year in. Your mind will be blown a year in, and you're going to be like, how the fuck did that happen? That's insane. If you have time, could you please go over different entry techniques? Do you always look to enter on the break of the previous 15-minute candle high or flip? I will go over that in a second. A win and a win. Agreed, Sam. Mike, have you ever studied ICT, I think you're talking about SMC, and if so, why do you prefer sticking to this concept? I have not studied it, and I don't want to look at it, and I don't want to study it. I completely understand it. I mean, you're talking about like fair value gaps and like the fucking order blocks and break of structures and 930 manipulation, New York high. See, I think it's just it's an overly analyzed and processed system that, like, I'm sure it works great, and I'm not bashing on it at all. It's just a lot to think about. A lot to think about, a lot to do, and I think that this is just a much simpler way of looking at that. Like, you think about the way that I trade. So let's just say we're talking about like a fair value gap. You have the break of structure happen before. You have price like have a very high push back into this fair value gap, and then you have a 15-minute candle close from this fair value gap bearish. And so, like, I don't know if I can even pull up an example. It's fucking crazy. I'm talking about this, but let's just say, oh goodness, Jew has been moving. What's going on here? Okay, so yeah, so let's just say this. You have, I don't know what a fair value gap looks like, but let's just say that would be a fair value gap. Bear with me here. This is going to be ridiculous. Let's just say that's a fair value gap, right? Whatever, or this is. Yeah, that. And that's your fair value gap where you want to buy, right? Now you're starting to say to yourself, okay, price is in a downtrend, but this is our uptrend. Right, this is our high, our low, and price is now coming back down into this fair value gap and giving us a bullish candle close. I don't care who you are or what you do, but this bullish candle close, this whole winded example that I just gave you with the fair value gap, the break of structure, I'm sure people would do so much more analysis. I'm going to tell you, hey, look, bullish candle close, you could definitely trade the next one. We're starting to trend to the upside. This looks great. And this is just like the way that I've become a trader and the way that I view the markets. And I don't think that there's a right or a wrong way to view the markets. And I think that ICT and all these concepts basically break down the same exact thing that everybody does. But everybody has their own lens and their own thing to do with it. Sometimes I'll see trades and people will be like, obviously you have your differences. Some people will be long on this pair, short on this pair, this on this pair, that on this pair, whatever. But for the majority of it, it's just simple, basic price action. I mean, you come back down here, you get a bullish candle, you go up. It's the funnest and the easiest way that I've seen to read the markets. So that's my thoughts on ICT and SMC. Double top. I love double tops, bro. That's awesome. Thank you for, yeah, of course. I love the session. This is great. This is great. This is about 3 hours. What I was expecting. It was a very long session. But there was some questions added. I was trying to get under 2 hours, but that didn't happen. And then entry techniques. Last thing that I'm going to go over here. And so I'm just going to use 2 examples that I have, so I don't have to look. Okay. Here we go. So entry every single time. This literally, like 90% of the trades that I take, you're going to see this over and over again. You have that sustainability formed at the bottom, and then you have the break of structure. That break of structure can either be at the candle's bodies or at the candle's wicks, and that all depends on my stop loss placement. So this was a loss here. I really like the sustainability, and I think I got triggered in on this candle actually here. I'm not sure. I can't remember. But I entered at the break of the highs of the bodies. And this was on NOS 100. So the spreads are a little higher. You got to take all that into account. You don't want to be triggered in too early. You don't want to be triggered in too late. And so I always enter at the break of either the bodies or the high, and I put my stop loss below. Here, this is interesting. But how I always take these trades, I always look for the lowest low that I can use to break. And so this is our lowest low. Oh, it's going to take a while. Oh, yep, there it is. So this is our lowest low, right, in this structure. You could say that, okay, if it breaks below this low, I could enter here. But it's not the lowest point. And if it breaks below this low, I'm not 100% sold on the fact that it's going to continue going down. And so what I wait for is I wait for the lowest point to be broken. And to answer my own question now of when do I pick whether I use the candle's bodies or the candle's wicks, in a situation like this, right, if this was my entry candle right here, this red one, then I would be choosing the wicks to go under because this is such a small distance. And there's already a bunch of wicks going on here. And so I'd be clearing that whole entire area 100%. And the fact that it's not going to add too much to my position, I mean, like, that distance between this entry and this entry is not huge. Now, looking to the left here, and why I use the bodies instead of the wick. Oh boy. What the fuck's going on? Come on. Oh my goodness. There we go. Okay. Why I use the bodies here, not the wicks, is because if you look at this, the rejection happened here, and as soon as it's closing below these bodies, I'm convinced that it's going to continue going down. Right? If this candle came back down and wicked like the previous 1, 2, 3, 4 candles, I might not fully believe that it's going to continue going down. Here on this left-hand side, we had one small reaction, and it continued going up, and it continued that downtrend. And so this is our inflection point. We can continually confirm that from here we're going to continue going down. Last one. This is the 3-minute, I believe. We have uptrend, right? We have that inflection point right here. Oh boy, wait, I gotta find it. There we go. So we have that. We have the candle close was right here, right? This is the candle close. And so from this point, we have a bullish candle form. It's at this point just pushing a little bit. And then we have that beautiful sustainability to the downside, supporting these lows. And then we have a great place to break. And now here, whether you wanted to use the wick or the bodies, I kind of just used in between. Just a fine entry, and I put my stop loss below. Because notice how on your entries, what you're assuming is as price is breaking structure, as price is breaking the structure to the upside, this is going to be the start of our next push phase. This break is what you're assuming to be the start of your push phase. And the stop loss is the assumption of where your current low, your new low will be once the high is formed. And so this is the only guess that we make. We take the guessing out of this as much as we can. But the only guess that we make is that, well, I guess two. One is that 15-minute candle bullish, next one will be bullish. That's one guess that we're taking. Or 15-minute candle strong, price will continue to go up. Not necessarily that the candle will be bullish, but price will continue to go up. That's one guess that we're making. The second guess that we're making is the entry. The entry is going to be the break of the high, stop loss under the lows. This is going to be what makes the new high. This break will cause the new high to be made. The new high that's made will cause this low to be validated. Which means our stop loss was right and our entry was right. And so that's a basic explanation of the entry criteria. I think there's one more here. Yeah. This one's very similar to the last one. This is on the 3-minute this time. Candle closes here. Candle closes there. bullish candle forms, bearish candle, we get that sustainability. We have a high to break, and we have a very good stop loss placement. We get entered into the trade, face some drawdown, price goes up, take profit. So notice how we entered at the break. We put our stop loss below what we thought would make the new high, which is up here. Oh boy. Which is up here. So this low made the new high. And that was true because we made that assumption and price respected that low the whole time. It didn't go below it. And that's what eventually made our high, which validates our stop loss, which validates our take profit. And so, yeah. Yes. That is all of the questions. That is all of the questions. That is everything. I actually think that a lot of these questions were super important to go over. And I might take snippets and little pieces of this out to post somewhere to go through them a little bit better. But I think these are really important questions. I mean, the sessions, the pairs, times to trade, candle closures, break even, not break even, A+ setups, growing accounts. I think these are all great questions, guys. And I really appreciate having you guys on the session this whole time. I hope you guys enjoyed this too. This has been a fun activity. And so informative. I'm very, very happy about that. Very happy to have you guys on. And yeah, and I might host these once a week, once every 2 weeks, on a as necessary basis. Next Coffee with Mike, I'm gonna post a channel in the Coffee with Mike channel, and I'm gonna make a thread in there. And as you guys start getting questions, I would like you guys to post them in there instead of in the main channel. And once the list gets long enough, and once the questions are in there for me to answer, I'm going to come back and I'm going to do something like this. I'm going to try to post this PDF of these notes that I had today. If you guys want it, I could post that too. And yeah, and that's all. That's all for me today. Please do. I will. No problem at all. And that's all for me today. I hope you guys have a fantastic rest of your Sunday. This was 3 hours, so not the worst, not the best, but good stuff. Thank you guys for being here, seriously, and take it easy. Okay.